All right. Welcome, everyone. And thank you to the thousands of online viewers joining us today. We know that your time is valuable. We appreciate you taking some time out to learn a little bit about a subject near and dear to me, options. So this is going to be a three-part webinar that you can join us for. My name is Jonathan Lord. I am part of Fidelity Investments and the leader of the trading strategy desk. My team provides education, self-directed individuals who are looking to make better and more informed trading and investing decisions. Options a big part of that we do. So you can find our content at fidelity.com/coaching and fidelity.com/classroom. There's also a link there on the right side of your page in the Q&A as we start to get started here. So if I were sitting you down, though, at a fancy restaurant, I'd tell you that today's content pairs very well with our options beginner classrooms. Again, you can find that there in the that link on the right side. So happy to be with you today. Our first session is going to be back to basics. We're going to be diving into, I mean, for the first time for some of you, what options are and how you can utilize them and some of the specific details of that. I am also going to be joined here, of course, today with Ed Modla from the OCC, constant collaborator with us and just a fantastic educator. So enjoy that for the first 2 hours with us too. After that, we'll be joined by the In the Money team, be doing the options play, talking about that tool, and of course, some of the other features of the beginner basics of options. The second class will be option strategies to help generate income. So hope you join us for all three of those. Before we get started, housekeeping items we need to hit, of course, for our online audience. On the right side, you will see the Q&A. As mentioned before, you can ask any question in there. Our moderators are ready to help you out. There's also closed captioning available below. So you hit that so you can see what we're speaking right live on screen. But now let's dive in. First session, I'd like to introduce Ed Modla. Once again, we did this sort of same thing about a year ago in Dallas live. Here we are through Zoom. So great to see you again. I'll hand it over to you.
Great. Thanks, Jonathan, and thanks to the entire Fidelity team for this invite. My name's Ed Modla. I've been in the business for quite a while, since 1997. I stopped counting how many years that is. Makes me feel old, but it's been a while, starting on the trading floors in Chicago and New York as an options market maker in the trading pits, and then spent some time as a futures and options broker, and now for over 9 years at the Options Clearing Corporation in the Investor Education Department. Specifically, all we do is talk to market participants and teach them about the options product, individual investors, financial advisors, money managers, anyone who wants to know about options. Me and my team speak and give presentations just like these and take advantage of the invitations and guest speaking appearances like we have here today. So yes, Jonathan said, back to basics today. We're going to be setting that foundational, fundamental level of knowledge that you need to have to understand options. There should be something in here for everybody. If you're new, you will learn an awful lot today. Keep in mind, learning options is about repetition. As you hear things, it might not sink in once or twice or 3 times, but the more you hear it, the more you will become familiar with it. If you are familiar with options, me and Jonathan are going to offer some insight and details along the way to provide you some education as well. First, our disclaimers, and now the outline for session number 1. Starting with the very beginning, the birth of the contract. Where does that come from, and how is that decision made? And we'll talk calls and puts and how those different pieces can come together. A bit about options pricing. And this can be somewhat of a mysterious topic for investors as they're starting to learn the product. And then, of course, they're going to be trading at some point. You're going to be executing transactions. So what do those order types look like, and what types of things will you be entering into your platform in effort to buy or sell contracts? And then, of course, as you'll learn here today, along with trading options comes the element of exercise and assignment. So we will define what that means and what you need to know from either the long or the short side. So first, with options listings, there's a wide universe of stock symbols that exist, and not all of them have options. Global markets, NYSE, NASDAQ, MIAX, Box Options, MEMX. Those are the 6 parent options exchanges. They will take a look through the list of ticker symbols that exist and decide, is there demand for options trading on this stock? There is a demand on technology and a demand on resources to simply have options listed and traded. So the exchanges do not take that decision lightly, and they have some criteria that they like to look at to give them some guidance. Of course, the shares need to be trading on a national stock exchange. They also look for $3 a share as a minimum level before they will consider listing options, and a few other criteria that the exchanges look at. And then, given all of these minimum requirements, it doesn't guarantee listing, but the exchanges then decide independently. Each of the 6 parent exchanges will decide independently, would we like to list options on these ticker symbols, and then they move forward with that process. IPOs is a common question. What happens after a very large IPO or a very anticipated IPO? And even then, you all likely, generally, do not see options listed right away. The exchanges wait for a few trading days to pass and some volume to accumulate before options get listed. All told here, not all stocks have options. The household names certainly do. And then somewhere in between, you do have options listed on stocks that don't trade very often. So you've got a little bit of a mixture of everything. As an investor who's looking to trade options, you'll look at that and you'll find out which tickers am I interested in that do have listed options, and is it something that I want to get involved with? So now let's look at the contracts themselves. To start, options are contracts between a buyer and a seller. Now, the buyer of an option is paying the option premium, what it costs, the option's price. We'll get that, get a few details on that later in this session number 1 today. But the buyer pays what it costs to buy the option, and in exchange for that, the buyer now has the right to either buy or the right to sell an underlying asset. And for our purposes today, this underlying asset is going to be shares of stock or shares of an ETF. The right to buy or the right to sell depends on which type of contract did they buy, which could either be a call or a put option. The seller of the contract is paid the option premium immediately. That's a cash credit into their account, non-refundable. And in exchange for that payment, the seller of the contract has taken on the obligation to execute a transaction in shares of stock. More specifically, the seller has been paid and has accepted the obligation to fulfill the buyer's rights, in effect, taking the other side of that transaction in shares that the buyer has the right to. So the control lies with the buyer. And that's what they've paid for. The seller will fulfill their obligation if called upon to do so, and they are paid up front for taking on that obligation. Of course, there needs to be a price at which this transaction might occur. That's identified within the contract itself, known as the strike price, and a duration. How long do these rights and obligations exist? There is an expiration date also identified within the contract upon which the rights and obligations cease to exist and they expire. The investor, whether you're a buyer or a seller, chooses your strike price. You also choose your expiration date, and these details, whether you're buying or selling, the strike price, the expiration date, go a long way to determine how much is the option going to cost. So the right to buy or the right to sell depends what kind of contract you buy. There are calls and puts. Those are the 2 types of options contracts. And I'm going to start here for a second and just define long and short for clarity. There's 2 definitions for these words, long and short. Many people understand the word long to mean I'm long the market, I'm bullish, it's going higher, so I'm going to be long shares of stock, for example, or just long the market because I'm bullish on where the market is headed, and that's long the market. Short the market is the opposite, of course. You have a bearish outlook. You think prices are going lower and you invest somehow into products that are going to appreciate in value as the market sells off. You're short the market. In the options space, there is another definition for these 2 terms. Long simply means you own the contract. You've purchased a call or you've purchased a put option and you are long the contract. It has nothing to do with market direction, just that you're long the contract. Short means you have sold it. You've sold short a contract. Nothing to do with market direction, but it means you've sold short a call or you've sold short a put option. These four pieces make up the entire universe of options strategies. Any strategy you see is a combination of these four pieces. The purchaser or the holder of a long call contract has paid for the right to buy shares of stock at the strike price they've chosen at any time until expiration. Now, the standard options contract that applies to all four of these pieces, the standard contract covers 100 shares of underlying shares of stock or shares of ETF. So the buyer of a call contract is long the contract. They've paid money, and now they have the right to buy shares of stock at the strike price, and they own that right up until expiration. The buyer of a put contract, think about it in reverse now. The buyer of a put contract is long the contract. They're the holder and the buyer, and now they have paid for the right to sell 100 shares of stock at the strike price they have chosen, and they own this right all the way up until the expiration date of the contract. You can think of this, for example, if you own shares of stock and you want to make sure you're able to exit at a certain price to the downside, purchasing a put option, one strategy that exists. Purchasing a put option, you pay money for this, and now you own the right to sell your shares at a specific price up until expiration. It can't get any worse than that. You can get out of your position at that price. One way that options can be used. Flipping over to the short side, the seller of a call option is short the contract, paid premium up front, and now has willingly taken on the obligation to sell 100 shares of stock at the strike price they've chosen and up until the expiration date that they have chosen. Most often, the seller of a call option is willing to take on this obligation because they already own shares and they're comfortable selling stock at the strike price they have chosen. In the meantime, they are paid the option premium for taking on that obligation, which they are comfortable with. And the fourth piece is selling a put option. Being short a put option puts the option seller or the option writer under the obligation to purchase 100 shares of stock at the strike price they'd chosen, and that obligation exists up until the expiration date. Again, these are often willing and accepted obligations. Selling a put option, for example, on a stock that's trading at $65, but you're really looking to buy it at 60. You might sell a put option and be willing to take on that obligation to buy shares at 60. You're very comfortable with that. In the meantime, while that stock moves around, you've been paid that put option premium, and that's yours to keep no matter what. These four pieces can be combined in all sorts of ways to come up with a variety of strategies. And this is just a sample of the different strategies that exist. Of course, we're not going to get into strategies in this capacity here today, but you just want to observe as you look around, how do these different pieces combine? Some of them profit on the upside, some of them profit on either direction, some profit off of a neutral environment. You see some strategies there. Some have high potential for gains, protected gains, high risk, low risk. There's all sorts of different ways to take those pieces, put them together, buys and sells, different strike prices, different expiration dates. And there's a whole lot you can do in the options world because of this, capitalizing potentially on bullish, bearish, or neutral environments. It really does open up a lot of opportunity, Jonathan. This could be a lot to sink in for beginners, but options do provide the opportunity for investors to take advantage of different market conditions. And again, maybe increase risk, maybe reduce it. So when you talk to clients, what is their perspective on why they're using options and getting started?
Yeah, this page always it's daunting, but it's kind of giving you that opportunity to look at, hey, this is what you can do with these things. And I hate saying it. I'm going to say it. I tell myself I'll come up with something better, but the options give you options terminology. It does. It gives you a lot of different things you can do making money in markets where stock is not moving, maybe where it is moving in one direction or another, and being able to sort of control that risk in different ways. So we know you got to start small. We can't just dive all the way in. I tell my kids, you eat an elephant. You got to one bite at a time. You're going to eat an elephant, right? You got to start very slow, build that foundation. So we threw a lot at you here. So I want to kind of get and bring things back around. I'll steal the screen from you and just go and just number one, show you on fidelity.com. Number one, if you go here and just to the products page, you'll see that we do have a page specifically for options as a product, how to maybe start even trading options, learning about it from the education and ideas that come out of this, the platforms and tools that are available, and even this FAQs here, frequently asked questions. I know a lot of you are going to be throwing some into the Q&A. So this is a way to also see if maybe some of your answers are available. Why? Why would you want to trade options? What are some of the available option tiers and how can you apply for that? And what can be done in different types of accounts? So a lot of that is already built in. You can see we do have some of these other concepts as you start to dig in and take those bigger and bigger bites along the way. But wanted to also sort of note, there's this function of all of these different types of securities that come out of this, of options, buying calls, buying puts, selling puts. And so where do you kind of start with this, or where do you see the universe of those available securities? And that is with what's called our option chain. I want to note and emphasize that these are what are called standardized. This is not something, when we say contract, a lot of people think about contracts as, oh, I got to go sign something. I got to go meet with this person and figure out who's paying what. And it's all sort of standardized through things like as OCC. And so everybody's sort of playing the same and trading the same things, the same expirations that was mentioned by Ed, that is part of your contract. So if you have weekly contracts or monthly or what are called leaps long-term in the future, those are going to be available and everybody's going to be seeing the same things. Those buying the calls and the puts sides of things are also here showing up on that. So that standardized process of saying the 91 contract for May 24th is the same one that everybody else is seeing. The contract is not something that you have to worry about somebody on the other side showing up and fulfilling that. It is done because of that standardization of it. So don't get too hung up in the weeds there. Now, we do want to note, and you can see here as I start to pull this up, there's a lot going on. It can feel like you're sitting down in the cockpit of an airplane, and maybe you've never flown anything before. You didn't get any training. So this could feel like, man, we are throwing things at you. That's okay. Start out small. Think about and again, as we get into some of these basic strategies, you start there. And as Ed and myself have been doing now trading for over a decade with options, doing education now for many years of trying to impart some of these concepts, but it is a long journey. And that is one of the beautiful things about options. If you really want to take things to that higher level, you certainly can, but you can also keep things very simple. And we'll get into those coming up soon, some of the strategies that are available to you. I was also looking at our option strategy guide and some of the various names. There's some really clever ones out there. There's a Christmas tree spread. There, you'll see all of these various names, but we want to keep things basic today. This is back to basics. So I wanted to show also to answer a few questions that usually come up. Things like, well, NVIDIA, that's a stock, right? So stocks will have various contracts. You will see the various dates. You'll see the strike prices, calls, puts, and then the ability to either sell or buy at those various contracts. So this would be the ability to sell a call, buying a put, selling a put, sorry, and buying a put, and the various dates with which you do these. We'll start to get into the pricing also, which will be coming up soon, which is why these things are priced the way that they are in their derivative contracts. The other thing Ed was talking about, of course, IPOs and stocks that have various ability to trade these. So I noted XLE is a ETF, NVIDIA, a stock. You can have SPX, which is an index. Also, you'll note SPX has May 23rd, 24th, 28th, 20. It has basically every single day that you can trade an expiration on this. And it has the various strike prices here are very tight, close together. Something like a lower value Siri at 274, not the same thing, dude. You don't get everyday expirations. You don't get those 5 dollar spreads on that's a higher level. These are 50 cents in between each one of these. So liquidity is very different depending on what you're trading. Some stocks won't have them at all. That was also mentioned by Ed. So just keep that in mind as we start to dig in a little bit deeper, that this is a little unique when you're starting to move between various types of securities and the liquidity that can come with different ones. Those are things that we want to set up for you as we start to dig deeper and deeper into what options are and how we can trade them. But wanted to give you a little lay of the land. I know, Ed, you can take the screen back whenever you're ready, because we have a little bit to get into, which is why these things are priced the way that they are, as we start to dive into the various strategies later on.
Yeah, really well done there, Jonathan. That's a nice presentation. And you brought up a couple of things that come to mind. Yes, the word contract can be misleading. It isn't something that is signed. You won't get something in the mail to read. It is that standardized terms. Options are fungible. You can buy them from somebody. You can sell them to someone else. You can buy them on one exchange and then sell what you own somewhere else. Really is just that standardization process that really helps. And then it was really slick to see how it was on the platform with the bid and the offer telling you what you can do. You can buy here, you can sell here. That's going to be helpful to keep in mind when we get to order types here in the next segment. But right now, yeah, just want to take a look at options pricing. There's a lot to dissect with an options price, and you could spend an awful lot of time on it. But there's really just two things from the ground floor that we want people to understand. And that, first of all, is where do the prices come from and who makes the prices? It is not a situation where professionals and market makers are setting these prices, or where exchanges are setting prices, as some people might think. Instead, all market participants, every bid, every offer, no matter who it comes from, that's me, that's you, that's everybody else, has an influence on where the options prices are moving and where they ultimately settle. Of course, if you're buying or selling one contract, that's not as influential as an institution that might be buying or selling 5,000 contracts. But at any rate, all market participants are contributing to the bids and the offers that move markets higher and lower. It is all about supply and demand and market dynamics, trying to find that equilibrium level where the buyers and the sellers are comfortable, and that's where the option prices settle. And without getting into too much detail, something else to understand is that call option prices and put option prices, in conjunction with stock prices, keep each other in line. There's a relationship there. It's more of an advanced topic, but a relationship that centers around how call options and put options in stock all move together. And it's important for those new to options to understand, because if you're buying a contract, you might be concerned, is this one contract that I'm buying priced incredibly high, or is this one contract I'm trying to sell for some reason very low, and I don't understand why, and I'm getting taken advantage of? It's really not the case. Options, along with stock, keep the prices in line, and all participants, anywhere and wherever they come from, are all contributing to where options prices ultimately end up. And the other thing that's very important, of course, you have buyers paying premium and sellers receiving it, but you can close these contracts. You can open a contract, and then if you don't feel like you want to have this right anymore, you don't have to hold it till expiration. You can close it. Or if you've sold a contract and you're no longer comfortable with the obligation, or maybe you've made money on the trade already and you want to close it out, you can go ahead and close the contract, exit the position. You do not have to go through exercise and assignment, and you do not have to hold it through until expiration. In fact, about 3/4 of all contracts that are opened are indeed closed before ever living until expiration. It is what we consider at OCC a myth that exists, that most options expire worthless. We've seen different numbers out there, 80%, 85% of options expire worthless. And that really isn't true. At least 70% of them never even make it till expiration, the profitability of which is impossible to calculate. Of those that do reach expiration, often it's because they've lost their value. So of that subset of 30% remaining, The overwhelming majority of those do expire worthless with no value because there's nothing there to capture. But most options are closed before ever reaching expiration. And keep in mind, when you see that quote, Jonathan was showing them up there, the quotes that you're seeing on the screen, $1, $2, $3, they are quoted on a per share basis. We've covered earlier that options cover 100 shares of stock. That's the right to purchase 100 shares or the right to sell 100 shares. So a quoted premium of $3 doesn't mean you're spending $3 aggregate dollars. Take that 3, multiply it by 100 because 3 represents per share, multiply it by the 100 shares covered, and that translates into 300 total dollars. You wouldn't want to be surprised clicking buy on an option that's quoted at 3 and then seeing a debit of 300 without understanding where all of that comes from. So Jonathan, that was a quick overview of premium. There's a lot more to get to, but at least some starter period here, getting people understanding what premium. Do you think investors get caught up on premium too much, or they more or less understand where it's coming from?
There's some epiphany moments that happen or occur, I think, when you start trading, is going, oh, that is why it's doing this. And some of that comes down to just even adding it to a watch list, letting and watching as the price of the stock moves and you see how it might react at different time periods. There are so many little things that affect the pricing of an option, but really it goes back to, as you're mentioning here, it's really the supply and demand. These are derivatives, though. They are deriving their price from the price of movement of the stock, and that can tell you whether something is relatively expensive or cheap. Could be a way to quantify that. Now, everybody will be arguing about that, and that's why these things move, because we're arguing about whether it is correctly priced or cheap or expensive as an option. So the premium, though, you do need to make sure you understand from a buyer and seller standpoint. I can give some examples of, I had a client as I used to trade for high net worth options traders. And so they would call in and we would either talk through strategies or I would place trades for them. And one of the example of this was somebody who said, things are happening exactly like they're supposed to, but for some reason my account value is going down, and figured out we were on the wrong side of the market. This client was actually buying options, watching them go, their premium erode to zero when they were thinking that they were actually option sellers watching that. So you need to make sure before you get into a trade that you are comfortable with the risk reward and know that buying a call and selling a call have very, very different risk and reward outlooks. So this sort of process of going in and learning, and by either, again, testing this out. So there are things that are sort of like paper trading. It doesn't have to be specifically paper trading, but you can enter those into, like I said, a watch list or a profit loss calculator to allow yourself to see what happens over time as stock price moves, but also some of the other inputs that go into options, which are things like time, volatility. There are all of these other factors that go into the process of thinking about an option. Interest rates, and not as much as, but maybe a little more than it was a couple of years ago, right, Ed? So this process of thinking about premiums, those are the things that you're actually, though, paying and you're receiving when doing that. So let me take the screen real quick. I'm just going to do a very quick, going back to that option chain. I want to show you guys again, just a little bit of that perspective. Got XLE up once again. This is an ETF. What we have here are those selling and buying. Remember, calls on one side, puts on another. And there's what's this called trade analyzer, which is part of this option chain. If you were confused as where to get to this, I do want to kind of show you the steps. Sometimes I get worried when screen sharing too much to go, all right, well, let's start bouncing around on these. But news and research, and if you go to options, that will take you to the options page. You then enter your symbol over here on the top left. That'll get you to the option chain. Option strategy builder will be shown in the next version of this second hour. And then our friends at OptionsPlay, you'll see them here as well in the option 3. So there you go, 1, 2, 3 in this. But we go down, we can see, once again, I've got XLE. We can see that it is trading at $91.64. That tells me, of course, that when now I start to look at these things like strike prices and dates, I start to have to formulate an opinion on what I think is going to happen with XLE. But in terms of pricing, you could note that there's pricing here on both these sides. And so if we only focus, for instance, on calls, That's usually a great place to start, is to think about what most people recognize, which is stocks maybe going higher in the long term or in short term, whatever their process is, they are bullish on that. That's what we usually think about when buying a stock. We are bullish that position because we want to participate in it going up in value. So this is a way to participate in that in a much different process in terms of the actual contract and the dates and the way that it is pricing and the risk that we are taking on to get exposure to that. But as we can see here, the 90-50, and these are going to be a little bit shaded. This is what is called in the money contracts. Of course, in the money is who we have as well, number 3, as the title of their name. But this is what we refer to as in the money. So we can see that these are already, the price of this is already above our strikes. These are what are referred to as out of the money, or if they are exactly the same, we would call that an at the money contract. And so we could start to see that by doing this, by going up in value, that gets a little bit cheaper. We can also find that over time at those same contracts, with more time, also costs a little bit more. So we start to find the relationship between these two things, time and then the strike price. And there's that unknown that, Ed, we won't get into today because it is a little bit of a different horse to saddle. That is volatility. And that is what you are referring to really when we think about the process of somebody buying or selling options and that supply and demand shifting an options price, because this is what you are trading. But there you go. By entering this, if I hit and go to click on this and say buy, for instance, this will analyze my trade. You can see that there's unlimited possible gain. This is a long call position. Your loss is what you effectively paid for it. If I buy one contract, that 100 multiplier that Ed talked about, we take that, multiply it out, and we can see that we are risking $128. Now, we need this thing to play along, don't we? We need our stock to move higher. This is a bullish position, but that is the basics of thinking about those trades. And we can see that by maybe moving up and going to a different one, I'm going to take this one out. And now we've got the 92. We're only paying now $28, but that probability of profit starts to shift and change. The risk and reward and the actual what we can expect in terms of probability starts to shift. That's a big part of what options are. They are based off of probabilities. They're based off of all of these factors being put together. And so making sure, though, you are understanding the premium that you are, in this instance, paying out as a buyer or that you are receiving as a seller. And then noting that when we do things like sell this contract, we just shifted very quickly, Ed. We went from unlimited max gain to an unlimited max loss. So you can see how quickly things can move if we're on one side or another. And the factors that go into that as we start to move along to figure out how to control the risk of trades. Risk always should be number one thought here. So we'll continue to dive into that in our further session. But I know as we start to get into it, Ed, you've got some discussion on the types of orders that we can look at. We do also have some questions that we'll hit at the end of this session. So stick with us for that. But we got a little bit more to cover. So back to you, Ed.
Yeah, this is the platform really makes a lot of things easy. It does a lot of the work for it. It's just a matter of understanding what you're looking at, what those premiums represent. And yeah, Jonathan, you mentioned it. People make mistakes sometimes, and that's why practicing might be beneficial. It would be nicer to learn some mistakes with virtual cash than real cash. But either way, sometimes you just have to make sure you understand what you're doing before you do it, and then watch carefully. Yeah, order types. Nice segue from what Jonathan just walked through to the different types of orders. We just mentioned opening transactions. You buy an option or you sell it. Subsequently, you can then close it, and most often that is indeed what people do. And that can be accomplished by identifying what you're trying to do with your transaction. Buy to open is a purchase transaction. If you're interested in, say, buying a call option, you would buy to open an order type to add or create something brand new. You don't have it in your account. You think the stock is moving higher and you want to own the right to purchase shares at a fixed price. That's a call option. Own the right to buy stock at the strike price. As shares move up, the right to own stock at your fixed price hopefully increases in value and you start to make money that way. So you buy to open something you currently don't have, and now you're long one contract in your account when that gets executed. If the market moves, say it moves higher and the option is worth more than what you paid for it, or even if that doesn't happen, if the market stays neutral or sells off, maybe the option's worth something less than you paid for it. But if you do reach a point in time prior to expiration where you no longer want to own this, you're ready to just sell it, take what you can get for it, move on to another trade, you would then enter a sell to close transaction. You're selling the option and you're selling it to close a position that you previously opened. So this is a sale transaction to exit or reduce a long options position. If you want to buy one call contract, it's a buy to open. If you decide, I'm going to buy another one, it's a buy to open another one. Now you're long two. If you decide at some point you'd like to sell both or even sell one, that is a sell to close. Choose your quantity and then execute the closing transaction. Most options follow this pattern of being opened and then closed prior to expiration. The opening and closing feature works in the opposite direction too. So again, options sometimes force you to put your mind in the opposite direction. Selling to open is a sale transaction to create or add a brand new short options position. You don't have any position in your account, but you want to sell a call contract and accept the obligation to deliver shares, possibly that you already own at a certain price. Or you would like to sell to open a put option contract and have that open obligation to buy shares at the strike price of your choosing and get paid to do so. That's a sell to open. And when that transaction is executed, you would likely see something in your positions that shows, say, a -1 or some way to indicate it is a short open position. Sell to open, if you want to sell more options, that continues to be sell to open, adding or creating new. At some point later, prior to expiration, whether the trade has been profitable or not, you might decide buying to close is the way to go. So that's a purchase transaction. You're buying the option and you're buying it back. You're closing something that was previously open. So it's a purchase transaction to exit or reduce an existing currently open short options position. Platforms do a lot of this work for you, but of course it's helpful to understand what you're looking at, what is going on. Opening versus closing transactions happening on both sides of the market. Closely related to that, once you identify what type of transaction it is, you then have to think about price. And there's a couple of different things you can do, which applies to stock and options first, market order. This is just an effort to execute your transaction immediately, buy or sell shares or buy or sell an option at whatever price is available to you at that time. That's in contrast to a limit order where you're going to place an order to buy or sell. This could apply to stock or options, but you're going to identify a price that you're willing to pay up to a certain amount that you're willing to pay. Or if you're selling, I will sell down to a certain amount. And this, places some control over what that order execution price might be. You could be aggressive with limit orders. If you place a limit order, maybe a lot of you trade stocks, you see the bid and the offer on a stock and maybe think, I want to buy shares here. So you enter in an order, you enter in a limit order very close to the bid of the offer, but by the time you hit submit, the stock's run and you don't get filled. And that kind of thing can happen with options as well. You can be more aggressive with the limit order and actually put an order, say to buy an option or stock for that matter, at a price above the offer or above the ask price. You're just being more aggressive in case the price does fluctuate a little bit. You're still willing to buy the underlying product at a no worse than specified price, just being more aggressive. It doesn't guarantee that you will be executed, but it places more control over your execution price. And then specific to options, you have spread orders. We're not going to talk much about spreads here today. We're keeping things simple, but for those of you who are trading options, multi-leg strategies, you might be thinking vertical spreads, condors, butterflies, things like this that involve multiple different pieces. Spread orders do facilitate entering in, buy to open, sell to open, whatever different pieces you have, and then doing the arithmetic that it takes to calculate what am I paying, add it all up, what am I receiving, add all that together and come up with a singular price, a net debit or a net credit. One price, you enter that in and attempt to execute the entire package at that price. Different ways to enter orders. Jonathan, you kind of tipped us off with that, with your visualization on the platform last time, but entering orders. Sometimes people make mistakes. You mentioned it, but hopefully people get the gist of it pretty quickly and you don't see too much of that.
Yep, exactly right. So again, some of the trade-offs that go to these is oftentimes people will say, hey, I just don't want a market order out there says you're getting whatever's the best available. And so that can be sort of that trade-off between the speed and access. And again, you want to think about liquidity of an option, whereas a limit order, you're specifying, you're being a little bit more picky about what you're doing there. So definitely important to know the trade-offs. Most lean towards a limit order unless you're on just a particularly liquid security or one of those that you just see a ton of volume coming in. There are ways for us even to look at the way that liquidity plays into an option. That'll be a little bit of a higher level and something that we would maybe run in one of our sessions. I'll show this real quick before we get into our final couple slides for this session, see if we can get to any questions as well. Just to share back and forth. We're back to it. This is our test account. This is not my account, by the way. And the test account is will at least give you a visualization of what this looks like. There is a long call for C, or Citigroup. It is the June 21st, 2024, 55 strike call. So real quick, if anybody playing at home says Citigroup is at 63.14, so we know that this is an in-the-money contract, and it's going to have a little bit of value to it. Thinking about that opening a door, closing a door, right? One of those hinges that can go both ways. When you buy to open something, you're going to need to sell to close it. This is showing that it is long because it just says 1 over here. If this was a short call, we had the selling this call and receiving premium, then this would show a -1. Also, Ed, Citigroup, 20 shares. Can I sell a covered call here? It's a little preview for next week. No, next time. You would need at least 100 shares to sell a covered call position. Just to keep that in mind, we'll come back around to it. But so this is a long call in the account. I can buy more, buying to open if I wanted to add to a position, or I can sell to close. Hitting sell to close goes right into that trade ticket. We can see here that this is 830 by 850. A little bit of a quick, simple math tells me that there is a midpoint of 840, right? That's 20 cents divided by 2 gives me, well, I'm going to add 10 cents or subtract it to get you to 840. That's in the middle. So most people will shoot for that midpoint. Now that is, you can put a limit there. And that says to make sure that I'm getting everything I can out of this. If I go and put a market order, I might get that 830 level. Again, if I'm thinking about these, everything is times 10. So we start to say that we are giving up money, and this can add up over time, especially if you do a ton of option trades, giving everybody $10, $100, whatever your contract size is, that can add up over time. You want to keep that money as much as possible. So putting in, that might be where you use something like a limit for that trade. So that is automatically defaulting because I clicked on it that way to that limit. I can sell to close this long contract. And we can see there that this matches up by clicking on it. If I wanted to open a new contract, I can just click here and there's those familiar buy to open, buy to close, sell to open, sell to close. So they pair up as buy to open. We're going to sell to close. If I'm selling something, receiving that premium, I'm an option seller. I have that obligation. Then I am buying to close it later. So this is what that trade ticket would look like on Fidelity.com. Preview, you place, and that'll send it out to the market, and that's how we get through it. But we got a little bit more to go. We want to hit the exercise assignment slides real quick. So I'll hand it back to you, Ed, just to pull that back up, and we'll get our sort of final thoughts in for this first session.
Sure. Yeah. And again, the Fidelity platform really makes it easy. It identifies everything for you. But of course, the education needs to back it up first so you understand what you're looking at. But yeah, Jonathan, if you do not close that trade early, if you don't exit and execute a closing transaction, maybe you do hold it through the exercise and assignment process. So it is imperative to understand what that looks like. First, with exercise, let's just remind ourselves buyers have rights. They've paid for those rights up front, paid the option premium to either buy shares or sell them, depending on what type of option they've purchased. That's 100 shares of stock that they have purchased that right for, and they can buy or sell stock at the strike price. If the contract is exercised, there is this concept of auto X, and I'll let Jonathan explain that in just a second, but only buyers may exercise at their own discretion. They have the right to do so at any time up till expiration. Mostly it's just at expiration. There needs to be some extra financial incentive to do so prior to expiration. That doesn't happen too often outside of the case of dividends, but normally at expiration is when you'll see this. But Jonathan, this auto X feature, how do you describe that and how does Fidelity handle that? What do investors need to know there?
Yeah, so it's getting exercise on the long side. We're the buyer. We have that right to exercise. You are paying that premium out. The way that Fidelity operates it is the penny in the money rule. So if it is again a 60 strike contract and the stock on a long call, for instance, is $60.01, we're going to go ahead and exercise that. We're going to put those shares in your account because you are on a long call. You are buying shares is the end of that contract. That is what you have entered into. So clients need to know if you don't want to exercise, well, you should probably close your contract. There's also the ability to call and to block exercise out of that. But again, most of the time it doesn't get there. There's usually a optimal sort of period where there's still this time value in the contract. And so a lot of traders will say, well, if I'm bullish and I'm still bullish, I'm running out of time, aren't I? The milk is getting towards the expiration date. Maybe it's time to go back to the out to the grocery store, get some new milk. So this is sort of that process where, if you do want to own the shares, you can let it happen as long as you can cover that 100 shares purchase in your account. And that's where things get a little bit tricky. I showed earlier Siri, which was in that closer to that $3 range. And we showed NVIDIA, which close to that $1,000 range. 100 shares is very different, isn't it? One contract in your account or buying 100 shares is extremely different for different types of stocks and different size. So do note that you need to be able to cover it. And so that can change some of the risk reward in your account as well. But we always want to be thinking about it. If we are exercising, we need to be thinking that if I'm bullish the stock, I'm continuing to be bullish. If I don't want to hold it anymore, go out there, you can sell that contract or attempt to sell it. If it's in the money, it's going to have some sort of value left in there for you to close that out. But yes, Fidelity very easily says, hey, it's penny in the money. The reverse, of course, for puts, the price needs to be a penny below the strike price for your put that you have bought in order for that auto exercise to go through. You would then be doing the opposite. You'd be selling shares at the expiration.
Right. Yeah. And then from my seat working for the Options Clearing Corporation, we facilitate exercise and assignment. And to explain, if you're wondering why does this feature exist as an industry procedure, think about, if we have people who own options, they're long contracts. And if they don't communicate anything to their brokerage firm, you can communicate nothing to Fidelity, and the contract is held through expiration. What does the Options Clearing Corp do with those options? We have to do something. They are either exercised or they're completely abandoned. Something has to happen, and as an industry procedure that we facilitate on our side, and then Fidelity also facilitates for their clients, this auto X, also known as exercise by exception. That's the official term we use at the OCC. If the option is in the money, meaning it has some value based on a comparison of stock price to strike price, then it gets exercised. Whether the option holder has communicated that or not, it does get exercised. If you're an option buyer, you need to know that. And all you need to do is manage that. And now, on the other side, assignment, of course, this is option sellers who've been paid, taken on the obligation to deliver shares of stock or purchase them based on what type of option they've sold, they receive notices. So it comes on the other side, Jonathan, it comes back to them. There's a communication process there, a timeline where option sellers are assigned. And then I believe, correct me if I'm wrong, it's more or less just automatic. Either the shares appear, they're delivered, it just happens. And you're assigned somewhat at the mercy of did the other side exercise? And that's how it would work, I presume. Correct me if I'm wrong on that.
Yep, exactly right. So you, when you are a seller of an option, so think about, we'll get there, the next session, covered calls, when you're selling puts, there's going to be that possibility of just happening to you. If you're if again, that covered call, you have sold a call against your shares. So you might wake up without the shares in your account, without the option in your account. That is what is happening when you are assigned. It is something that is happening to you, but you have really no control over, except usually to sort of reduce the risk of that happening. We still call that assignment risk. So there's usually ways to kind of say, yeah, there's a high probability or a low probability of getting assigned here. You need to be aware of this because assignment, if you're in a taxable account and you've got these long shares that you want to hold on to and you've sold a call against them, you're not going to know ahead of time that those shares could get sold. You just might have to, again, do some things to assuage that risk and to reduce it by maybe changing the expiration or changing the strike price through the act of what is called rolling a contract. That's another sort of next step. We're just throwing different terminology at you. We know there's a lot. There's definitely some great, again, education and dictionaries out there that'll go into all of these things, but hopefully we're starting to see some of that spaghetti stick against the wall here. But once again, this is that process of assignment. It is randomized. I will say that as well. Something I used to get the calls on all the time. Why me? Why did they choose me? It is a randomized process, not even with Fidelity. It's across the entire industry. So if somebody exercises, you just might be maybe even not logical. It definitely happens. We just had a conversation with a client the other day. It said, why in the world did this happen? He said, well, people aren't logical. Sometimes they will exercise something and you don't even have any idea why. The risk was low, but it happens. And that is the risk that you are taking when selling a contract. So just to keep that in mind. But this is nothing you can do. You can't call Fidelity and stop that assignment. That is on the other side. Exercise is where you talk to us to exercise or to block exercise. Assignment is what happens to you at the end of the contract or at any point in the contract's life, I should say.
Yeah, excellent. I think we're running out of time, but yeah, I do want to pick up on that one point. Options don't have to qualify for exercise and assignment. If you're on the short side of this, you have the obligation and you're watching the stock price, think, okay, it doesn't have any value here. I'm in the clear. I'm not going to be assigned. Not necessarily true. An option holder can exercise at their own discretion, even if, as Jonathan said, it's illogical and not in their best interest. It could happen. That's what they paid for, the right to do that. So you have to be careful when you're selling options. Jonathan, I think we're running and ticking low on seconds here.
Yeah, 2 minutes over. I was hoping to get some of these questions. Hopefully we answered a few of them. I kind of get to peek at the Q&A behind the scenes here to see what you guys are asking. So definitely, once again, we're trying to answer these in the process of when I'm bringing these through. We'll see if we have some time again in the next one, but we are over time on the first one. We need to take a quick break. You all, just a reminder, we have the 2 more sessions. So just stay on this page. You don't need to log out or register again. The second session will start in about 10 minutes. Well, I guess now 7 minutes. We'll be right back. It'll be myself once again and Ed getting into some of these option strategies. You'll also receive a thank you email later today if you can't make it to the next one. Make sure you read that. It will provide you some additional educational resources. But thank you, Ed. We will, again, be right back. Hope you all enjoy your time here. All right, ready. We are back. A quick 7-minute break. But this is session 2. Again, if you are joining us for the first time, we just hit back to basics, talking about options, what they are, where they come from, the idea of how you can use them, the types of orders, exercise and assignment. So we're going to get into The real things like strategies, option strategies to kind of help you to generate premium income. So this is going to be, we're going to get into a couple of different option strategies. Of course, my name is Jonathan Lord, again, with the Trading Strategy Desk, current leader here. We are a team of individuals who try to make better traders, try to talk about what's going on in the markets, technical analysis, the basics of trading options. So we do these all day, every day at fidelity.com/coaching and classroom. And those links should be there on the right side of your page. Speaking of, that is the Q&A. If you were with us and stuck with us, there still should be some questions still up there. You can vote those up, add your own comments along the way. We'd love to hear from you in there. Also, the closed captioning is available. Click on the bottom of the screen to join there so you can see what we are talking about if you're maybe in a loud, crowded place. It happens, but we thank you for joining us, learning more about options. This is going to be another fun one where we're going to get into a couple different strategies that go with trading. So we will also, of course, stick with us for round 3, though. Ed and myself will get a reprieve. We'll get to watch from the wings as the In the Money team kind of talks through their options play with my friend and colleague, Constantine Brandopoulos. We'll be back. So we will, again, get started. Happy to join you again here, Ed. We are from the OCC talking through the option strategies. So I will kick it back to you.
Great. Thanks, Jonathan. Thanks, Fidelity, again, for the invite to speak here today. I'm Ed Modla. I've been in the options business since 1997, starting with a few market-making professional trading firms on the exchange floors, in the trading pits. I was in the Dow pit, the Amazon pit, IBM for a bit. So I got my experience down there, learned the options product as a professional trader, and then moved to a few different sides of the industry before now the investor education team at OCC. This is all we do. Myself and the team of 5 content creators that I manage. We teach options, we write material, we give these presentations. That is our job and purpose of existing. We really appreciate you joining us today. And again, thanks to the Fidelity Group for the invite to be here today. The topic here, generating premium income. So we are going to be talking about selling options and what our Thanks to the Fidelity Group for the invite to be here today. The topic here, generating premium income. So we are going to be talking about selling options and what are a few of the ways investors can do that to help manage their portfolio. Specifically, as we walk through, you can think about one thing here. The strategies we're going to be going through really are an effort to become more conservative than if you were just buying shares of stock and owning shares of stock. Options have this tendency to have myths that surround them, and one of them is they're just too risky to implement into a portfolio. But what we're going to talk about here today is a few ways you can use options to implement a position that has lower risk and is more conservative than just owning shares of stock. And that's what we'll walk through here in this session. First, our disclaimers, and the 2 strategies that we're going to focus on. First will be covered calls. What is a covered call? How is it put together? The motivations and risks of doing such a strategy. And then just a hypothetical example. What does that risk profile look like? And what is this investor trying to accomplish? And what do they need to be concerned about? We'll take that same approach with cash secured puts. What is that strategy? Why do investors use it? What concerns might they need to have? And then from a profit and loss perspective, what does it look like? And then we'll close with a few comments about monitoring and managing positions. That'll take maybe the first half of the session. Then for the bulk of the second half, Jonathan will take over control of the screen and show how these strategies can be implemented and analyzed on the Fidelity platform. So let's get into the covered call position. This has 2 pieces to it. Before we put that together, let's just review what it means to buy and sell call options. Take a step back. What does this mean? Again, this is not stock transactions. Stock trade on their own exchange. Related to that, on their own exchanges are options, calls, and puts, and people are buying and selling them. So what are call options again? Call options can be bought or sold. The equity call buyer is paying premium, whatever that option costs, And in exchange for that purchase price, that payment that is an immediate debit out of their account, a cash debit, they own the right to buy shares of stock at a particular price, and they own that right for a certain length of time. The price that they can buy stock is something they will choose. It's called the strike price. And the duration for their rights before it reach expiration, that's also something they choose. How long am I going to have this right? So the better price they choose, the more this option is going to cost. The longer time frame they choose, the more it's going to cost. But those two selections are within the discretion of the option buyer. That stands to reason that if you buy a call option, you're bullish on the share price. If I own the right to buy stock at 70 and I have that right for the next month and the share price goes from 75 to 80, well, what I have is the right to buy at 70. It's worth more. The stock price goes to 90. The right to buy stock at 70 is worth even more. So bullish on the underlying, and the effort here is that the stock price does move higher and has a positive influence on the option that I own, to a greater extent than I might lose through what we call time decay, or this, you can think of this as the passage of time occurring without the stock moving higher. If I don't get that stock movement within my time frame, the value of this option is going to start to decay, and that's going to accumulate from one day to the next to the next. I need the stock movement to go higher in my favor to a greater extent than I lose value through the passage of time. On the other side of the transaction, the equity call seller is paid premium, paid cash credit into their account immediately, and has accepted the obligation to sell underlying shares of stock, specifically 100 shares. And they are under this obligation to sell stock at the strike price they have chosen and for a duration of time they have also chosen. Similarly, if you choose at lower strike prices at which you will be selling your stock, or if you choose longer durations, the higher the premium gets. But that obligation, of course, changes, and you can select the strike price and expiration date that more or less fits what you would like to have in your portfolio. Undoubtedly, the option call seller, the equity call seller, already owns shares in their account. So the obligation to sell stock, if called upon to do so, is going to be fulfilled with shares they already have. Remember that options cover 100 shares of stock. So if I own 100 shares, I can sell a call option at a strike price of my choosing and take on the obligation to sell the shares I own at that strike price that I am comfortable selling stock, and I am paid along the way. So that's the construction of both sides of equity call options. Now let's focus in on that equity call seller who does own shares. It's called the covered call strategy. Another name for this is buy right, and I'm going to draw a distinction there. A buy right is often considered to be when the shares are purchased and the call contract is sold simultaneously at one singular net price. Covered call, generally speaking, is when shares are owned, maybe owned for a period of time, and at some point later, a call contract is sold to cover that. But either way, the two pieces are long stock and short a call contract. The call writer sells to open one call contract for each 100 shares owned. Jonathan mentioned it in session one. If you don't have 100 shares, you cannot sell a call contract, which obligates you to sell 100 shares of stock. If you don't have 100 to deliver, you cannot do a covered call. Part of the name here, covered, means that your obligation to sell 100 shares is covered because you already have the stock in your account to deliver. This potential assignment or delivery of your shares at the strike price that you have chosen is possible at any time up to and including expiration date. Equity and ETF options are American style, which means on any given day, there could be assignment. Most likely that's not going to occur if you've sold options on a stock that does not pay a dividend. it is rather unlikely to see an assignment occur early. If there is a dividend, it does add a little bit of complication or likelihood to it. And if you're wondering why that's the case, think about the option holder or the buyer's perspective. Even if the stock rallies sharply and I have the right to exercise and buy stock right now at a much better price than the open market is going for, you might think to yourself, well, why doesn't that person exercise and get stock at that much better price? And the reason is they don't have to. If they want to continue to hold that position because they're still bullish, they do not need to exercise early and come up with that cash before expiration. They can just simply hold the option and continue to benefit from the share price moving higher without dealing with exercise, particularly early exercise. Also, if they're willing to close the position, if they're done and the stock has rallied and they're really willing to get out of this position and take a profit, a much more simple course of action is often to just sell the contract that is owned, to not deal with exercising, but simply sell to close the option that is owned. That's why you don't see too many options get assigned early. But again, that dividend part does change the equation a little bit. So in return for all of that, the assignment, the potential delivery of shares, the call writer receives the premium, and that's why they're executing this trade in the first place. And Jonathan, I'll get your thoughts here before we look at maybe a little bit deeper dive into the strategy, motivation, risks, and the examples. Your investors, the clients that you're talking to, their understanding of this strategy. How popular is it? Is it for people, beginners, seasoned investors, all of the above? What are your initial thoughts on the strategy?
It's definitely where people start. The covered call is effectively saying, hey, I'm willing to part with these shares. Again, I'm neutral to bullish. And I'd like to take a little bit of income here. Maybe I'm sort of creating that income stream. Some might refer to it as sort of like a dividend, right? I'm creating my own dividend. The key thing, though, that you need to remember is you're giving up that upside potential. If the market does, or this stock does, or ETF goes flying north up in price, you don't get to participate because you've sold that right away. You have sold it to the option buyer, in this instance, the buyer of the call. So that is that risk reward trade-off. This is also just not one of those swinging for home runs style of trades. This is a slow and steady income generating, just picking up those dimes, quarters, and maybe, again, different risk for different types of different sizes, but they can add up over time. We have some great tools that you can utilize to sort of find opportunities. You may do a strategy of just looking for specific stocks for this, or you might look for types of volatility for looking for opportunities here. There are so many different ways to trade this. The key thing, though, Ed, is this is a covered call. We mentioned 100 shares, and this is what we always wanted to emphasize. 100 shares is covering those shares. The end result of a selling of a call is the selling of shares. That is the handshake agreement you've made by entering into this contract. If you have the shares to sell, well, that's easy. I just reach my back pocket, hand those shares over to the other side. This becomes very different if you don't own the shares. That's what's called a naked call writing, and that is one of the most risky contracts there is. So very different. Having 100 shares, one of the most conservative strategies. Going the other direction, not having the shares, one of the most risky strategies. Very, very different. So making sure that you understand that concept of what you are giving up and what that process is of if this, then this. Always be thinking about risk first. What's the risk when trading these options? This is also another key point I like to add is that this is not a protective strategy. Occasionally we'll get that phone call where somebody will say, I sold a covered call, got me some protection. This is not giving you that protection in this instance. This is, I call it, it's the Swiss cheese parachute. It's not going to do much for you. It gives you just that little bit of income, but the stock price is what really is going to drive the long-term loss or gain in this position, which is if this thing's going down, it's not giving you any of that protection. You're just simply collecting, and the max gain you can receive is that premium that you received for entering into the contract.
Yeah, that level of protection is minimal, and it just takes one or two bad experiences to learn that the hard way. And yeah, you're right. 100 shares, one contract. If you have 300 or 500, you got 1,000 shares of stock, you can sell up to 10 contracts. You can choose however many you want. You can sell 5, or you can sell 3, you can sell 8. You can choose different strike prices, different expiration. There's all kinds of different things you can do, and the options world just opens up those kinds of doors once you get familiar with the product. Motivations and then risks, and then we'll look to the example. We'll just bounce through the next couple of slides rather quickly. So the motivation is rather simple. You're looking to increase returns through the option premium that's kept and received, because you do have a reduced cost. Now, you bought shares and that was a cash outlay, but now that cost was reduced. And so you own shares effectively at a better price if you put those premiums together. So primarily increasing returns, and we'll identify where exactly that happens. But you're also want to make sure, no matter what you're doing, this strategy or anything else, that the strategy implemented is consistent with your market outlook. Here, a bearish outlook or concern from the downside is not consistent with this strategy. As Jonathan said, it really isn't protective. If you have concern about downside, the covered call does not fit that narrative. This is a strategy that will add to your bottom line in a neutral, but more specifically, modestly bullish environment. And also, because you've reduced your cost, you now have an overall lower cash outlay. You've improved your break-even point. When you do that, you increase the likelihood or probability that the trade as a package is going to be successful. You give something up. Jonathan teased it earlier, that upside potential, particular to the far upside, but in exchange, balancing out your benefits and risks here, you do have an increased likelihood of being profitable because your break-even point was reduced. As far as the risk, it's fairly simple. Two sides to this. Your upside profit potential is limited because you have accepted the obligation to sell the stock at the strike price. If you wake up and overnight news has triggered the stock to rise sharply, you might not be able to capitalize on that because you already committed yourself to selling stock at a particular strike price, and you need to be comfortable with that. I often get questions from investors who want to use this strategy, but they don't want to give up the shares. And that question really is contradictory. How do I sell covered calls, making sure I never have to deliver the shares? And that's where it does get tricky. There are ways to manage that, to try and avoid assignment. And I think Jonathan mentioned at least once here today about rolling positions. You can change the strike price. You can move expirations out. You can close your short call before dealing with assignment. There's things you can do, but it is a bit contradictory to want to ensure that you don't sell shares, but also implement this strategy on top of it. That upside potential to the far upside is limited while the strategy is intact. And then the downside loss. Do not forget about this. The downside loss is still substantial and significant. You have a very minimal amount of protection that's provided by the call premium received, but the downside loss is still going to be driven by movement in the stock price, which can be theoretically down to zero. Here you see a hypothetical example, stock XYZ, and what it looks like as far as a risk profile is concerned. This investor owns 100 shares of stock at 75. Let's say they bought shares, they were very bullish. They've owned shares for a little while. They're not so bullish anymore, but they do think maybe 80 or slightly into the low 80s is feasible within the next month or so. But that's what their forecast is now. So instead of holding stock at 75 and waiting for that 80 price level to come to fruition, maybe setting a limit order to sell stock at 80, which is a choice of yours. An alternative here, sell a call option that goes out about a month's in time, choose the 80 strike and receive, remember this is $1.60 per share times 100, receive $160, get paid $160. So now there's long 100 shares of stock, and there's short one strike price 80 call option, obligating the investor to sell shares at 80 if the other side of the transaction, the buyer chooses to purchase stock. So let's look at it and how this translates from a profit and loss perspective. The dashed line is just holding long stock at 75. As stock rallies, we're making money. As the stock drifts lower, we're losing. This blue solid line is your covered call risk profile. At 75, if the stock stays right here, we actually have a little bit of a gain, because remember, our net cost now is the difference between these two. We paid 75, we received $1.60. That moves our break-even point, BEP break-even point, down to 73.40. That's that element of reducing break-even, giving us a higher likelihood of being successful. And effectively at all levels, to the downside, to the upside, up until this intersection here, this would be $81.60. Up till that intersection, the covered call outperforms long stock. It's only above that level where the stock continues to make money, where the covered call cannot. So this is a risk reducing strategy. You're spending less, you're reducing break even, being a bit more conservative than if you just held stock. Your potential loss is going to be a bit less. But as Jonathan, you said it earlier, it's only by that $1.60. That can add up if you're doing options over and over and over again, or doing this regularly. But it is just that little bit of buffer. So Jonathan, as you look at this, the risk profile, what other things or conversations you have with clients centered around this concept?
Yeah, absolutely. So thinking about that, once again, giving up that potential upside, but how often do we find that a stock or index or it just kind of moves sideways, doesn't it, in sort of this time period, and you're not able to take advantage of that? Thinking about 6-month periods where your stock was at 100, and what happened 6 months later? $100. It didn't do anything. Maybe you got a dividend in there, but this is a way to enhance your trade by adding in that additional level, but you are still neutral to bullish. We'll continue to sort of hammer that one because it's going to come up again. But these income strategies are once again slow and steady. You'll get there. This is what we refer to as a hockey stick graph when I was in college. So you can just see that blue line that's diagonal going down and to the left keeps going. So we want to be thinking about the process of either exiting that trade or having a risk management process of saying XYZ gets to here, I got to get out of this thing. And if it's going down, what's also happening is that my call is getting cheaper. So there's that little tiny bit of protection, is if I'm wrong and the stock does end up having bearish price movement, starts to pull lower, then I can once again exit, buy back that contract. Remember, we got to do that. You have to think of these things as a pair now. Your 100 shares and your call contract that you've sold, the one contract. So keeping those things together. But these now as a strategy, this covered call, or also referred to as a buy right when bought together. So if you already have 100 shares, you can go out and just sell that call. We'll show what that looks like here shortly. But thinking about this trade, this is once again, one of the ones that we would see most common as sort of that entry point. This is something that you can add and think about, once again, the same way, sort of in a paper trading capacity. Add this to your position and say, let's see what I would receive. I got $160 if this stock doesn't get above this level. Okay, let's see what happens. Time is also a huge thing in this. Time is in your favor as a option seller. This is something that you can use in your favor as time starts to move and the stock has not done what most people expect it to do, which is a lot of times we may get really bullish or really bearish on a position. You will find that oftentimes it doesn't play out that way. The arguments between buyers and sellers continue. This is a way to take advantage of that. So I'll reiterate that and reiterate the giving up of that upside potential. That is where we'll get into here shortly, which is also the process of managing, rolling, adjusting when things start to change or when start to get close to maybe one of those levels. Continue to move and adjust and bring in income and keep with the strategy even as the price starts to change.
Sure. Yeah, absolutely. There are clear benefits here to this strategy. That's why it's so widely used. But yes, it does have to be consistent with your market outlook. You do give up that upside. You think the stock's going to 90 within a month? This construction really isn't going to work for you. You have to think of them as a pair and make sure what you have in your position, in your account, is consistent each and every day with what you'd like to have as far as a market exposure. Closely related to that, just on the other side of things, is the cash secured puts, another somewhat conservative way to get into a stock position. That's the way we'll look at it here when we walk through the strategy. So do an overview of put options. What does it mean to buy a put option? The put buyer is paying the option premium out of pocket. That is an expense, immediate cash debit. They're not going to get that money back. They've paid for it. Now they own a put option. They are long one put option. It gives them the right to sell shares of stock at the strike price they've chosen, and they have the right to do so up until expiration. This could be a speculative trade. If the investor is bearish on the stock, they might buy a put option. If shares go lower and lower, from 50 down to 45 to 40 to 35, and I own the right to sell stock at 50, the value of what I own continues to increase. So that's a bearish speculative trade. It also could be a protective trade. If the shares are owned, if I own stock at 50 and I want to make sure if this thing sells off, I want to make sure I can get out at 45. You could put a stop loss in to sell stock at 45. You do carry overnight risk, weekend risk, gap risk when you have a stop order in for the shares, or you can buy a put option, which doesn't have overnight risk, weekend risk. The put option is working for you in the form of protection 24/7 around the clock until expiration. You pay for that, and now you have the right to sell stock at the price of your choosing up until expiration. But again, that comes at a cost. On the other side of the put buyer is the put seller, who may have different motivations entirely. Starts with the put seller receiving premium paid cash immediately into their account and accepting the obligation to buy shares of stock at the strike price they've chosen, and more or less generating this premium income we're talking about while waiting for a share price to drop, because the motivation could be to get long stock, but just at a price that's a bit lower than where stock is trading right now. One choice is to use a limit order. Stock's trading at 55, you want to buy it at 50. You could put a limit order to buy shares at 50, or an alternative, sell a put option. Strike price of 50 is what you choose. Now you're obligating yourself to buy shares at a level you're comfortable with, and you're going to get paid the option premium waiting for that to happen. The premium is yours to keep even if the stock rallies or the stock remains neutral. If it does drop, then you might be called upon to buy your shares. So let's set this up with an example. An investor is bullish long-term, but thinks the current level is a bit too expensive. What can they do instead of just watching and waiting or setting an alert, which are perfectly fair choices for an investor to make? Something else would be sell a put, get paid premium, and choose the strike price strategically. So the obligation to purchase shares at that level is something the investor is very comfortable with. The motive might be to purchase at a lower level. So what happens if the stock doesn't sell off? Well, if it does rally right away, then you may have a trade that got away from you. And that's a risk you would need to consider. Selling the put option is obviously not long stock. So if you get the rally a bit quicker than you expected and you didn't buy any shares, it could get away from you. Or here's one to really consider, is if the stock drops below your strike price, it is unlikely that you'll be assigned prior to expiration. So if subsequently the stock rallies back above your strike price, you might never get assigned. And again, not get the stock that you wanted. You can manage this. I've seen this happen. I've been through this experience many times myself. If you see that occurring and you're concerned, I really do want this stock, there's too much time left till expiration, my option might not get assigned, you can just go ahead and proactively close out the short put position and buy stock. I mean, you can get the stock if you really wanted to manage the position. But if you didn't do that, it is possible that the shares dip as you expected, then rally as you expected. And if all of that happens prior to expiration, you might never get the shares of stock that you were hoping to get. Assignment, of course, can occur on any trading day. There doesn't have to be a qualification for the option to be in the money or to have value. An option holder can exercise and assign you at their discretion. And the downside risk is substantial here should shares decline sharply. And that's quickly outlined. It's a very much more simple P&L graph here with cash secured put, stock at 146. We think that's too expensive. We'd rather not buy stock at 146. So we sell this put option. Details here are what was used in an option calculator to get a realistic premium. So with a month to go, we sell a 140 strike price put for $2. We get paid $200. And now if we're assigned, if the stock is below 140 at expiration, we are likely assigned or buying stock, and our break-even point effectively is 138 because we were paid $2 up front. So Jonathan, a little more simple strategy here. There are things that can go wrong. Of course, there's ways to manage that, but by and large, again, generating premium income from a few different ways with that long stock in mind. I'll just add from the level of 146, selling a put is a bit more conservative. So just sort of dispelling that myth that if you use options a certain way, use them responsibly, not necessarily high risk. But Jonathan, popular strategy as well. I would sure you would agree.
Definitely is. We'll note, and of course, you mentioned that these are basically the same when you look at them from that hockey stick graph, aren't they? They're what's called synthetics. The structure of them works out to both be neutral to bullish. They're both bringing in income. They both have risk to the downside. They both capped upside potential. Everything starts to look very closely the same. And you'll find, of course, in this next section for number 3, where we'll start looking for ways to screen for these sort of opportunities in some ways using that OptionsPlay tool, or there's other ways to think about this as even together as what's referred to as the wheel strategy. We're combining these two income strategies together to again, bring either, once again, being bullish, to lower some of those break-evens, to acquire shares, to bring in income, then selling calls on top of those shares. And so this really interesting sort of process that you can build over time, especially if you are neutral to long-term bullish on those positions. So they look very much alike. Really interesting way to think about these and to get exposure to the market, to control some of that risk, and to, once again, utilize what options you have, which is that leverage in some cases. I do also want to note here that the cash secured put. So I mentioned earlier, you had a covered call, you reached in your back pocket and you delivered those shares. They were covered by the shares in your account. The end result of a put when you're selling is buying shares. A sold put says I will buy shares at expiration, or if I am assigned, I have to buy the shares. Remember, the call was a selling of shares. Shares don't do anything for me in a cash secured put, does it? I already have shares. Well, I need to buy shares, and I can't just trade those in because those shares that I had in my account are fluctuating. So I have to use cash in this instance to go out and purchase those. So a cash secured put is covered by the amount that would be needed to buy 100 shares of that stock, or index, or ETF. So just a real quick note on that one. So I'm happy to start diving into, again, some of the tools that we have at our disposal to start thinking about, one, placing these trades or analyzing them, finding opportunities. Definitely what we want to actually put into it here is the practice involved. So I'll take the screen back from you unless you had anything else to add there, Ed.
No, yeah, I just want to add real quick, because you did get on an interesting thing. For those of you who might be a little more advanced and know the product very well, you mentioned the synthetic or comparable nature between cash secured put and covered call. Absolutely true. If you want to jot this down, an interesting thing, if you were to buy stock at 146 and sell the 140 call for $8, it would look exactly the same as this. That's what Jonathan mentioned, that synthetic nature. So when you get these slides, think about that and see how that plays out. Buying stock at 146 and selling the 140 call for $8 would provide this same exact structure. So that's an interesting way to identify the relationship between call, puts, and stock. But go ahead and take the screen.
All right, very good. So we'll start here. Of course, this going back to Fidelity.com. A couple other things to note. I did real quick have another feature here, which is the options. Going back to options trading, this answered a few of those questions that had come in. We also have the option strategy guide on Fidelity.com. So this is, if you just search for option strategy guide, it'll take you to this. There's your short put or cash secured, a nice little write-up by the Options Institute at CBOE. talking again about some of these features, digging a little bit deeper. So Fidelity has a ton of stuff that you can go and dig into if you need some light reading here this evening. Of course, I know the OCC also constantly doing education, so we want to make sure that we are continuing that process here. So let's go back. We were on the option chain earlier. I want to go over to the second button, the option strategy builder. We're talking strategies, thinking about those two that we've just so far brought up, the covered call and the cash secured put, two of many different types of strategies, but probably two of the most commonly used that we will see on the, of course, on the income side of things. So I put in Apple here. Market's struggling a little bit here, but we'll put it in. Apple, we refresh this and see where we're currently standing, 187.48. So let's go to the next button. We've decided that Apple is where we're trading. Maybe we utilize something from an outlook perspective. The most common approaches here, we can see your technical analysis, something I'm a chartered market technician. That is what I teach, is technical analysis as an approach to finding opportunities, especially in thinking about supply and demand and where key levels that price might run into, for instance, and be rejected. And maybe that's a level that I want to sell a covered call at, or maybe there's support, or maybe there's trend and I can take advantage of those utilizing some of the historical moves in price. Fundamentals I can think about too from a long-term perspective, or maybe I'm trading into an earnings report. There's all of these different ways that I can think about trading options, but this is where you might start. Typically, traders might also think about the combination of the two. Fundamentals to say, what do I buy? Technicals to say, when do I buy or when do I sell? Or how far can price go before maybe it needs to take a little bit of a rest. So thinking about that is our outlook. You need to have an outlook, right? You can't just come in here blind and be like, I don't know, this sounds good. You can't just pull it out of a hat. We want to have an outlook that says, I think that this stock is going to go up. It's going to remain flat. It's going to go down, maybe a combination of the two we've already mentioned. These should be, there's a little bit of that spectrum. I think it's going to go way up. Maybe I think it's going to go up a little bit. So there may be sort of in between. You'll see when I click on each one of these that spectrum shows up in those strategies. So going up, also referred to as bullish. You ever heard that one? Going down, bearish. Ed, I've been trying to get this to catch on, remain flat. I think I'm going to start using crabbish. You think about a crab running along the beach, going nowhere, remains flat. So there you go, crabbish markets. That's kind of what we're looking at oftentimes with these two strategies, neutral to bullish, remaining flat or going up. Those are the two things I want. There's a spectrum here. I can be much more bullish even in these strategies. I can be a little bit more neutral. It can be typically we don't go too far the other direction, but there is, again, it's not black and white. I tend to think of these things when we're teaching them as one way to do this. There are some spectrum here when we think about the expirations and the strikes that you're selecting. That's next steps. Don't worry about that yet. But covered calls and cash secured puts do show up here. We can see that there are these terminology and there are these same sort of graphs with some nice colors added in. So them next to each other. Covered calls, generate income. Cash secured covered puts or cash secured puts, also generating income. Targeting buying the stock. This would be targeting effectively a sell price. Some people will say, I'm going to put a buy limit order in. What if I just get paid for that buy limit order? If I'm going to put a sell limit order in, this is another way to sort of say, I'm receiving some income if it doesn't get hit within that time period. A lot of that is where we try to think about these two types of trades. So we can select whichever one we want based off of what we see typically, again, maybe with price. So I can select cash covered puts. That was the last one we talked about. But this, again, is identical, right, Ed? We see it. This, you can tell which one of these things are not like the other. Well, they're both the same. They're the exact same setup when we think about the trade. They have different types of risk or different types of process to go into them. But the risk is the same. Stock price dropping, the risk of giving up upside potential if the stock were to fly. So we go here and hit next, and we start to see that we are now going through the actual process of thinking about expiration. Expiration, you can see that this goes way out. Apple, of course, very much so, has a lot of different ones. You can see earnings on August 1st here, telling us that this might be a sort of binary event where we might see a large movement in price. I think NVIDIA this morning, or excuse me, yesterday afternoon, now this morning's move. And so how an earnings could have a very short-term impact. So you want to kind of think about that oftentimes when trading an option, but you can select one. We typically, with expiration date, also, as you move a little bit further down the line with selling options, you'll learn that there's typically sort of a sweet spot here, just mathematically. I won't get into it, but there's what's called theta that's involved with options, and the speed with which theta moves is typically shorter term tends to work. And then you will tend to roll or adjust those contracts over time. So we don't always need to get it all in one chunk, right? We can use shorter term and then continue to do the same trade if this remains the same outlook. If outlook changes, we need to change our mind and change our process. So that's a long way to say this. And then going through, we can see that we can change some of our probabilities. And this also changes some of the amount that we are bringing in. This changes the bid, the break even. As we start to move things up and down, we also find that we are moving either in the money, out of the money, or at the money. Once again, this was a question that came up earlier. In the money, once again, with a call, means that the stock price is above that level. That means that you are entering into a contract, for instance, at 185 to sell at 185 your shares. What's at 187? That means it's already got some value there. If we're doing puts, of course, on this one. So it's the opposite. In this case, when opposite here, we're reversing that. So we are just doing simple math to come up with in the money or out of the money there. So in the money, in this case for puts, will be in this gray area. Out of the money will be below. At the money is going to be this level. So we can change that, adjust our limit prices, adjust our quantities. As we do that, we can see that that changes, of course, the risk reward. Once again, be based on how much money we're putting into this. If we are saying 3 contracts, effectively remember that at the end of this, you would have to be buying 300 shares of Apple, but also that if the stock price drops, again, this is not a free ride here. You will be participating in that drop, and you don't want to think about it because it's just a low amount of premium that you've received. You have the risk of the actual shares involved, and that can be that move very quickly, especially with cash covered puts and the risk that can go into those trades. So this is how we might adjust this. Of course, there are a few things. There you go, in the money. If you wanted to read about what some of the definitions, we take this, we review order. We've gone through the process. We've selected maybe our strategy based off of some other analysis, our outlook. We've looked at expiration date, strike price. I will want to emphasize that these are just randomly me clicking. These are not even by any means am I making any sort of judgment here. Probability of this one, of course, showing that 51%. Stock price could go up or down from here. That is the price. The options do not have any sort of inherent bias to them. They don't say, we think that this app is going higher or not. That's what the market will tell us. And so this sort of process, once again, proceed to the order ticket. We can go in, click that, make sure we have our account selected, and this will look very familiar. So this is called the Option Trade Builder. Very good for newer investors who are getting into this from a beginner option standpoint. You do need to have applied for options, have that on your account, have the correct tier available for you there so that you can do these types of trades. But it is important to note, you can then take this to the preview order place and you are off to the races. You are selling puts on Apple. The other way to do this is through actually just placing it within the option chain. You don't have to go through the option trade strategy builder. You can simply sell a put through the option strategy over here. Cash guard put is one. You can just have puts selected. You can go through, choose your expiration. You can collapse those expirations and say, I want to go to June, 22 days away. I want to go ahead and sell those puts. I can click that, gets me to that same page very quickly. This is NVIDIA in this instance, by the way. But this would be those process of creating these types of trades. You go in, place your limit, place your market, whatever you want to do to place that and get that into your account. That is how you do it. Let's see, we've got a little bit of time left, so I'll go through real quick. There is this buy right that's available. This is the other way to do that trade in one fell swoop. This is buying the shares and selling the call. This gets a little bit tricky for people to kind of think about sometimes. Remember, you're doing both of these at once. That's why this number looks really interesting. What in the world? Buy 1,011.66. What we're doing when purchase is going through is we are selecting this. Take these out. Let's do that again. We are selecting this to buy 100 shares and to sell in this case, sell to open one at 26.35. So it is reducing, again, that amount that we're having to pay. Once again, goes back to Ed's slides there. So this would be a way to put these together. What's your estimated max loss? That's because you're buying the shares. You're paying that much. The most you can receive for selling that call was 344. So we're just subtracting that out of what you had to pay for the original shares. But this would be a way to place that order. You can see that break even and probabilities as you're going through these trades. So really interesting method of going through this. If you already have the shares, you don't need to do the buy right. You can simply go straight to a call and then sell that call yourself. And that will pair up with your shares. All right, we've got about 5 minutes to go. Want to give it back to you, Ed, if there's any final thoughts there, and we'll start getting into some of the questions that I'll queue up. But these are definitely two of the strategies we see quite a bit. These are two very introductory process for entering into a trade, but they still have risk involved. We always want to think risk first. Ed, what are your thoughts there as we go into sort of the management of those before we get to the questions?
The only general comment I have, and this is really not even educational, but it's just as watching you do this, and if you're trying to absorb this, there's a lot going on, a lot of numbers on the screen, but the different tickers, the strike prices, the bids, the offers, the strategies, the pieces, you might already start to see, once you become familiar with all this, how much fun it is to use options and implement them in your portfolio. Jonathan, I don't talk to too many individuals who say, hey, Ed, I took the time to learn the product. I know it really well, and I'm not going to use it anymore. It's the opposite. When people learn the product, they continue to use it. The ones that use it, don't have a good experience and stop, usually are the ones that didn't take the time to learn it in the first place. But there's just a lot going on, but it's a product that's fun and enjoyable to implement in your portfolio if you do it right.
Yep, absolutely. If you want to learn a little bit more, join us. We have a lot of fun here on the Trading Strategy Desk. Our Trading Strategy Desk coaching sessions, we'll get into these things with option trading. You can see here that 4-week classroom was also there. And then we have in those topics, advanced trading, that's your option strategy guide, and trading options are two of the sections there. Yeah, Ed, with our remaining time, let's hit real quick, go back to the slides and just show, I know we had a couple on the management, right? You entered into the trade, what now? You gotta be thinking ahead. You can't just forget about it once you've entered into the trade. We mentioned that. And then if I have one or two questions, I'll be try to hit the end here.
Yeah, let's just close here then. Yeah, you're right. So options are not something you just kind of set and forget. You don't leave it alone. Jonathan walked through this earlier. Options also don't trade themselves. Some questions that might come my way are, what's the best option strategy? Which one works the most? And that's not really a question that can be answered. Options work as advertised. Their risk profiles will show you where you gain, where you lose, where the benefits and risks are. It all starts with planning the trade first, getting that first step down, whether it's through technical analysis, fundamental analysis, or both, or as Jonathan said, you're selecting bullish, bearish, neutral, I think he said crabbish. You're selecting something, and then you go into your toolbox and you find the strategy that fits that forecast and market objective most appropriately. The more strategies you have, the more opportunities you're going to have to pull out something that's consistent with your market outlook. And then it's monitoring, managing. Dynamics change, positions need to be tracked, changes need to occur, rolling positions, be aware of the calendar, whether it's specific to a stock with earnings or something that's coming out specific on a micro level or macro level, a big unemployment number, GDP numbers. Know what's out there and what you might want to get ahead of or avoid. It's a lot about monitoring and management, but also what makes managing positions and using options so dynamic and interesting. So Jonathan, I think we've got a couple minutes or a minute or so to take one or two if you had a highlight question.
Yeah, if I could find the unmute button. There we go. Yeah, management, again, we're just going to hit that very high level. You, of course, have to have that, but that is that next step. Enter to the trade, setting alerts, being able to analyze and be able to say, I was wrong. Maybe I need to adjust that. Being honest with yourself and having a process or a system in place is really what we try to teach here on the desk when we're doing that. So I'll hit the real quick question. Somebody asked about, well, how do we find ideas? That's one of those things that we can hit very quickly. I want to just go ahead and jump in. There are, of course, various types of traders. If you're looking to find ideas, well, you need to maybe look out in the market for types of stocks, either, again, technical, fundamental, ETFs. Mentioned you can do an ETF screen. This is a great way to look for, maybe you're looking for a theme, maybe you're looking for a specific size. In our stock screener, you go to news and research and then go into stocks. There's a stock screener and you can go in and see all of the criteria that's available to you. There's one over here, Ed, optionable. I want to make sure they have options is going to be a big part of that. Also, maybe you're looking for something that also pays dividends, dividend yield. You're looking for valuations, price to earnings growth ratio, PEG ratio. Maybe you're looking for earnings per share. Maybe you want to see analyst opinions. Maybe you want to find some technical analysis and say, I want to look for a Bollinger Band breakout that's occurring. All of these things, once again, we do try to teach technical analysis as part of my desk as well. But this is something that you can utilize to whittle down the whatever it is. Let's go option. Let's just do it. Optionable. Let's see how many we have available. 9,000. Well, let's see. Securities with option 2,963. So there you go. Available through this screener to choose from. That's a lot. And so this is allowing us to then go through, you're not going to analyze all of these. You're going to go through this process of saying, maybe I want to find a stock that's been moving higher and I think it needs time for a rest. Maybe I want to find one that has a specific volume in play. Maybe I want to find one that's a specific size so that I'm getting a certain exposure. So stock screener is a fantastic tool for that. Then we can dive into some of the other numbers to sort of figure out where we want to enter and exit on that trade and what kind of trade we want to put in place. So that was one of those. Another that came up, another question, and maybe Ed, I'll kick this to you here for dividends. Can you talk to us about, specifically on a covered call, what happens with dividends when that occurs in the account? How does that look, or what are some things we need to think about?
So when thinking about dividends, that question often comes up with the early exercise feature of call options. If you're selling an option, you're selling a call option, you got a covered call, early exercise likely not going to occur in the absence of dividends. But when you do have a stock that's about to pay a dividend, specifically the ex-dividend date is upcoming, remember the call holder is not a shareholder. They are not entitled to a dividend payment. So if your call option is in the money, the likelihood of being assigned increases. There's some deeper math that goes into exactly what strike price adds to that likelihood, but just keep in mind with an upcoming X date, an in-the-money call option does have an increased likelihood of being exercised early.
If you're looking for that, we usually have X date posted everywhere. That is the one, that is when we need to be aware of it. The X dividend date, X meaning without, tells us that that is the day that it no longer trades with dividends. So what you'll find is that it's the day before that you could have that assignment that occurs. And guess what? You don't know about it until the next day. That's the tricky part. These are overnight assignments that occur. So as of the prior day, you've lost your shares, you didn't get that dividend. So that is one of those things when I said earlier about assignment risk, when we're getting very far to maybe the end of a contract and we're finding that X dividend date, in this instance of June 7th, is coming up very quickly, that's where we want to be careful and start thinking about, maybe I want to adjust to that trade. That management starts to occur, paying attention and knowing what can and possibly could happen with your trade, specifically that covered call, so that you don't get the adverse result and you're able to continue and the way that you would like to trade. But anything can happen. That's what the fun part of trading is. Lots of surprises. You learn along the way. We say start small. Definitely, again, don't try to do it all in one chunk. Make sure that you're using this process, building that understanding of what these things mean. Talk to somebody. Come to our sessions. Come to Ed's at the OCC. All of these things you can do to make sure that each time you should be starting to have a little bit more of that sticky spaghetti against the wall, right? That we're trying to think about. You may not be able to get everything that we talked about today but you'll find that over time, this can build and this can be a very important part of your portfolio and trade, and utilizing options to adjust that as well. So Ed, final thoughts here. We are almost over. I got to get out of here so we can clear the room for our next group, but I'll let you say your final goodbyes here for the
yeah, we're just at thank yous. Thank you, Jonathan. It was a pleasure being with you here today. Thanks to the Fidelity team for having me, and I hope everyone has enjoyed the session, learned something, and enjoys the final session coming up here in just a couple minutes.
Yep, I'll be watching them as well. So we'll clear the room. We'll be joined here shortly, and again, stick with us.
Hello, welcome in everybody. We're back here for another episode of In the Money. Today is May 23rd, 2024, 3 o'clock Eastern Standard Time. I'm excited to be here. I want to welcome our regular audience, of course, those who follow us on a weekly basis. I very much appreciate you tuning in. Would also like to invite and welcome our newcomers who are probably brand new signups from this Fidelity special event about back to basics when it comes to options trading. So we are excited to have you and certainly hope that we will see you turn into regular followers of the show. I'm Konstantin Vrandopoulos of Fidelity's Trading Strategy Desk, and with me today, as always, I have the talented duo, Jessica Inskip, Director of Education and Product at OptionsPlay, and Tony Zhang, Chief Strategist at OptionsPlay as well. It's great to see you guys. How are you?
Hey, it's great to see you as well, Konstantin. Thank you for the lovely introduction there. Excited for today's conversation.
Yeah, fantastic to see you, KB. Looking forward to a great show.
Yes, I am looking forward to it as well. We have quite an interesting week unfolding here. Of course, today is Thursday. We still got one day to trade tomorrow, but a lack of upside follow through in momentum terms, I guess, and risk assets broadly. We were trading at brand new all-time highs in major indices that we normally follow just as early as this morning, but we're seeing a decent sized pullback here intraday. You know, there's an old German proverb that is famous on Wall Street, and that states that trees don't grow to the sky. So sometimes, I guess, some consolidation of previous strength is to be expected. And maybe some of the brand new latecomer bulls are eating a little bit of humble pie this afternoon. Tony, what are you making of all this action? What are your thoughts?
Yeah, thank you so much, KB, for that introduction. All eyes this week, I would say, have been on the NVIDIA earnings that came out yesterday. Those earnings did come out better than expected, both in terms of EPS and revenue, as well as forward guidance. And that's why the stock is up about 8% today. But I do think overall, from the market perspective, you have a bit of this buy the rumor, sell the news type of event in terms of price action that we've seen today, as you see quite a bit of heavy sell-off today as we reach kind of new all-time highs earlier today. From my perspective, when you look at this from a macro perspective, this is more than just what we saw going into the NVIDIA earnings this week, something I spoke about last week, which was just the makeup of the rally that we've seen here over the last 5 to 6 weeks. When we look at the sector rotation over the last 6 weeks or so, what's interesting is that as markets printed new all-time highs, it was the defensive sectors that were leading this market's higher, which is not something you typically see near all-time highs. You had utilities, you had consumer staples, you have healthcare leading this market higher. What the one sector that you typically do see these types of movements higher is technology, but that only started to performing here over the last couple of weeks, and we do see some of that reverse here today. On the flip side, the question is, whether or not the true offensive sectors, consumer discretionary, materials, industrials, those have been the sectors that have lagged behind as markets printed new all-time highs. So when you see defensive sectors lead the markets higher when they print new all-time highs, that doesn't particularly scream a strong bullish market where we're going to print new all-time highs and continue to move higher from here. So from my perspective, when you look at this from a macro perspective and you look at those internals, there's really two ways this can potentially play out. Either the offensive sectors that have been lagging behind start to play a little bit more offense and actually start performing, or what you can start to see is the S&P 500 potentially start rolling over. And the question is, which one of these two things are going to happen or more likely going to happen? In my opinion, I think that based on what I've seen so far, and especially based on the price action we've seen here today on the back of NVIDIA earnings yesterday, I think my bet is more in the latter, where I think that there's more likelihood that the S&P 500 could start to roll over here from here, even though we just printed new all-time highs, which traditionally would be considered a bullish signal.
Understood, Tony. Your point is well taken. Jessica, I'm curious. I know that you are an avid market viewer, participant, watcher, strategist. I'm curious if you share the same thoughts, or you're looking at something a little bit more specific.
Absolutely, Constantine. Great question as always. And to build on your proverb in that analogy, we're focusing on the trees. Let's take a step back and look at the forest, if you will. AI is a very important narrative, in my opinion, to sustain this bull market. And so we need to consider, just from that educational perspective, what we define as the market. When we're analyzing the market, oftentimes we're referring to the S&P 500, which is market cap weighted. So that means that the biggest companies hold the biggest piece of the pie, have the ability to literally move the market, because we define it is about 30% driven by technology, 5% of which is NVIDIA. And mind you, that the weighting of the SPY, the ETF that mirrors the S&P 500. But that means that the AI narrative matters on how we define the market. So NVIDIA, the way that I look at it is from duration and demand pool for AI. Where is the money going? Major four hyperscalers are Google, Meta, Amazon, and Microsoft, which means we're getting insight into CapEx or really a spending boom. And not to mention, there's major tech events in the month of May with AI related releases. We've got AI agents now that are AI speaking to us. We have AI PCs, and we haven't seen anything from Apple yet, which has merely been whispers and rumors. And perhaps there's going to be an innovative release of some sort from WWDC, which is in early June. But focusing back on those hyperscalers, again, which are Google, Meta, Amazon, and Microsoft, they stated that they're spending $177 billion this year alone on CapEx for cloud and AI, where that spending's going, and $225 billion globally on CapEx. So altogether. And so I'm looking really at the viability of that spending. Where is it going? Where's it going to? So that brings me back to NVIDIA. NVIDIA, like Tony stated, it beat revenue. Certainly, yes, earnings. It beat revenue. It was much higher than expected. There was a 10-for-1 stock split for stockholders as record of June 6th, and there was an increase in their dividend. So just diving deeper into the numbers, the street was expecting a 200% revenue growth. We topped that. There was a 427% jump in data center revenue. And the jump in data center growth was, quote, reflect higher shipments of the NVIDIA Hopper GPU computing platform used for training and inferencing with large language models, recommendation engines, and generative AI applications, end quote. That's from the earnings release. Now, I'm looking for momentum on the Blackwell chip, as progress might have capped this. It's still revolutionary aspects, but we might be in that early stages, which could be more incremental. So we got to think about, as exciting as that sounds, in my opinion anyways, the risks. We have to factor the risk and highlights of NVIDIA. NVIDIA is accustomed to 70% drawdowns. When it goes up, it goes up. When it goes down, it goes down. And when expectations aren't met is when those drawdowns are highly likely to occur. In other words, we say this is a high beta security. And that's just focusing on the AI narrative. If we take a bigger step back and look at the overall picture of the market, I think we have to discuss some other risk factors that we saw this earnings season. I see cracks in the consumer. Citi CEO Jane Fraser, she cited that there is an impact on the low-end consumer. Target did, McDonald's did, as did Starbucks. We pay a lot of attention to economic data on this show. And so I'm looking to see how all of this will translate into retail sales, inflation data. We're getting some next week, even unemployment data. But AI is one narrative. Consumer health, interest rates, those are others all playing out in the market. They're related. If companies are becoming more leveraged, so they're spending a lot on this AI narrative, that CapEx cycle that I'm speaking of, a rate cut could benefit the recycling of that debt. They're issuing the debt. If it's at a lower price, that's going to be great. Whereas a rate hike may have negative effects. So a lot to certainly consider when we're analyzing the market and all of these narratives that are playing out, Constantine.
They certainly are. Seemingly changing each and every day. So it could be confusing for customers and clients and investors. So thank you for clarifying some of those points. Tony, let's wrap this all up together. Put a nice bow on it. What is a trade idea that you have in mind for today to share with our audience?
Yeah, thank you, KB. My trade idea this week is actually going to be a macro trade on the back of what I was laying out here at the beginning of the show, which is some of the concerns that I see as we print new all-time highs on the S&P 500. Because typically when you have S&P 500 print new all-time highs and the VIX print new 52-week lows, this is typically seen as a bullish signal on all accounts. But like I said, when you look at the internals of what has constituted this rally into these new all-time highs, I think that this actually warrants potentially buying protection when protection is quite cheap at the moment. This would allow investors to remain fully invested so that if there is further upside, they're able to participate in that while giving away what is virtually a very small percentage of their portfolio's value to get that downside protection. So one of the things that we typically look at, as I said at the beginning of the show, is kind of what sectors are performing as we've rallied off of that April 19th lows. And what's really interesting is that what we saw was that utilities performed well, healthcare performed well, consumer staples outperformed the S&P 500. These are sectors that, with the exception of healthcare, have a pretty small weighting in the S&P 500. And despite the fact that they have such small weighting, they've managed to carry the S&P 500 to new all-time highs. That really speaks to how strong the defensive sectors have been. Technology, did start performing here, but it really has only been in the past couple of weeks, and we're starting to see a bit of that reverse here today. On the flip side, when you look at consumer discretionary, you look at materials, you look at industrials, these are the ones that have lagged behind the S&P 500 in this rally. And when that happens, that does not scream to me this is a strong bull market that's going to continue to print new all-time highs. And then if you look at the chart of SPY, the ETF that tracks the S&P 500, what's really interesting is that as we made new all-time highs, the price made a new higher high, but momentum did not confirm those new highs. Those are some signs that buyers are exhausted, and that was the reason why I thought that there's the possibility that this was going to roll over rather than the offensive sectors will continue to start performing and actually and continue this market higher. And more importantly, one of the things that I think is important for a lot of investors to pay attention to is volume. One of the things that I noticed that, as you see from the April 19th lows, as the markets moved higher, volume continued to decline. As we made new all-time highs, we actually saw declining volume. And on a day like today, when the market sold off pretty heavily, volume was very heavy. And that really speaks to, again, further that buyers are exhausted and sellers have a little bit more strength here in the moment. And that's why, when I think about this, the two ways that could potentially play out, where offense either comes back into play and starts performing and we start to print new all-time highs with strength, or this starts to roll over, even though there's I would say a 50-50 shot of which way it goes, I think that when you think about the fact that the VIX is trading at a 12% 52-week low, it makes sense to simply stay invested in the market and buy some puts because of how inexpensive they are. And this, like I said, what that allows you to do is that participation because you're invested in the markets. But if it does turn lower, you have some protection by buying puts in this current market environment. So the trade structure that I want to use is a very simple one by going out to the July expiration, and I'm looking at buying the 529 puts on SPY. These are about a 40 delta in terms of a strike price, and earlier today you can pick those up for about $6.77, which equates to just under 1.3% of the ETF's value that you're risking to buy this downside protection. And this would buy me protection for roughly 2 months out. And that 40 delta strike means that for every $1 the SPY ETF drops by, I should expect to make about 40 cents back on the option itself, giving me about a 40% protection on the drawdowns here, while in this particular case, like I said, risking 1.3%. So even if the markets continue moving higher and I don't need this this downside protection, I'm giving up 1.3% of my portfolio's value over the next 2 months to have that protection in place. And you're only able to do it right now because the VIX is trading at those 52-week lows.
Yeah, Tony, great points here. I mean, we looked at a chart of VIX, and earlier this morning when it was under the 12 handle, it was the lowest level that we have seen effectively since the pre-pandemic market environment back in the very early 2020. Just to put it in context of the cheapness of implied volatility, especially those downside puts in the S&P 500, just to put it in perspective, if you are thinking about putting on this trade, what does 1.3% really represent? Well, yesterday's price action, peak to trough, intraday, right, during real-time market hours, the market was down around 70 basis points. Today, peak to trough, it was down almost double that, 1.4%, while the market is down right now from the prior day's close of 86 basis points. So, relative to the last couple of days worth of intraday moves, it certainly seems like that implied volatility or that premium of downside puts is relatively cheap. Question for you, Tony. I'm sure that a lot of our audience participants are pondering this idea. So for you as a strategist and someone who is managing risk or thinking about managing risk through the utility of this trade, when you put on a hedge, do you treat it the same way as you would if you were just thinking about speculating on downside move, on the downside move in the underlying without owning it actually? Or do you just treat it as a sunk cost, put it on, close your eyes, and if the downside happens, you sleep well at night, and if the continuation to the upside occurs, you're participating in that upside. Do you treat these trades the same, or do you manage the hedges differently?
Well, that's a fantastic question. And generally speaking, I think whenever you're trading options, especially when you're buying options like I'm doing here right now with put options, you always want to consider, regardless of what reasons you're buying those put options, you generally want to consider the premium that you pay for those put options as a sunk cost, meaning if you were to lose 100% of the premium that you pay, you should be comfortable with that amount of risk. However, despite the fact that you are comfortable with losing 100% of that premium, meaning thinking about this as a sunk cost, generally speaking, as in terms of best practices, if this trade is not working in the direction you expect it to, meaning the markets are continuing to drift higher and continuing to move higher, I do think that there are opportunities to manage this trade and cut losses at some point where you're not risking 100% of the premium that you're paying, especially in an ETF where there's fewer overnight gap risks. You have usually the rule of thumb that we have on these straight debit type trades like a long call or the premium that you've paid on this. So I'm paying in this particular case just shy of $7 on this put option. If I lose half and 30 cents or so on that, I would think about cutting losses on that and towards my next trade. Because at that point, once you've lost 50% of the premium, chances are the original thesis that you had is not playing out, as certainly perhaps not in the time frame that you're expecting to, and you're better off saving that other 50% for the next trade rather than hold markets will turn back around and that you'll need this protection.
The line go down, right? You're hedging because you want obviously to continue to participate in the upside while managing your risk on the downside. Jessica, let's bring you into this conversation. You have a trade idea that you're looking at today. Let's go ahead and get into that one and share it with the audience.
Absolutely. This week, I am looking at CEG, Constellation Energy Corporation. I wanted to keep the AI theme going and discuss some potential headwinds that I see emerging. When we're trading options, we need to remember that options are derived from an underlying security, which means that if you're utilizing options as an investment vehicle for the long term, we pair that with an investment thesis. We have a view on the underlying security. And there is no doubt, in my personal humble opinion, that AI demand is here to stay, as I laid out during my macro thesis at the top of the show. AI, though, is utilizing a lot of power. Every new iteration of NVIDIA, those Blackwell chips, it becomes more efficient. But the issue arises as demand is just growing at this astronomical rate, as we're seeing with these earnings numbers. So grid pressure, it's becoming a byproduct of that compute growth, meaning I'm in search of companies that are taking this headwind, so I'm utilizing my investment thesis here, and turning it into a tailwind. So I'm screening for power providers that can bring to market faster, or on alternative, something like nuclear power, quickly and at better margins. And so CEG was the result that marries my investment thesis and outlook. Now, once I've so from a technical perspective, I have my own methodology. If you haven't heard from me, we normally look at a 2 to 3 year chart, and I pull the 13, 26, and 40 weekly moving averages. Those indicate to me the trading cycle. And the reason why I use the 13, 26, and 40 is because it represents 1, 2, and 3 quarters worth of rolling prices. I tend to view the market quarterly, especially as we're thinking about earnings. And I want to apply this method with a technical lens and want to see the averages sloping upwards. That indicates that there's a bullish trading cycle. Conversely, if it's downwards, it's bearish. Currently, the 13-week is acting as support, so I see that as a good sign as well when I'm assessing the technicals. Now, I've added today Bollinger Bands to this chart. Bollinger Bands, math behind it, it represents 2 standard deviations from the period that we've selected. Here, the period is 20 weeks. And when I'm analyzing a stock or that trend or that trading cycle, and I'm looking for trend strength, I'm utilizing those 2 standard deviations. Is it hugging the top of that range of deviation? If so, I assigned strength. If it is deviating away from that, then I'm going to assign a fading strength of that trend. That trend is fading its strength, and that is a flag for further investigation. So therefore, with the investment thesis, I'm neutral short term, adding that layer of technical analysis, but I'm bullish long term. And the way that we can apply that with an options strategy is via selling a cash secured put. It's a method that I utilize often to add positions to my longer term portfolio. So a cash secured put, the sentiment of that is neutral to bullish. And the reasoning behind that is we're collecting an upfront premium. When I sell a put, I'm obligated to buy the underlying security. So I'm utilizing that obligation to add the security to my longer term portfolio. Earlier today, CG was about 221 and I'm selling 30 days out expiration, and I'm looking for an at the money put. So earlier today, that's a strike price that is very close to the current market price. And the intent is to purchase the stock. So I'm selling the June 21st, 220 put. It's a premium of about 575. And I received that premium upfront. It's an upfront credit, and that acts as a discount to purchasing the stock in comparison to the current market price of about 220 again at the time of the trade. But what that means is I am obligated to purchase the stock. which means I retain full stock ownership risk. If this were to move adversely, I'm highly likely to be assigned, at which case I would purchase at that strike price, but that's offset by the upfront premium that I'm receiving. So the breakdown in more simplistic terms is a short put obligates me to purchase the shares at the strike. In exchange for this obligation, I'm receiving a premium. And I structured my trade with a strike price that's relatively close to the current market price. And I call that an at the money option, or we call that all an at the money option. And if the stock does move adversely, I essentially would own the security, which is my intent with this neutral to bullish view.
Very good, Jessica. So you would be buying the stock if the security finishes on June 21st, finishes the day of trading underneath that 220 strike. The likelihood, right, goes up tremendously. Now, you've laid out the risk of this trade very well, which is something that is important for novices to keep in mind. Always, what is the risk versus the reward? We focus on the trading strategy desk on the risk aspects of options trading quite a bit as well. That is in our mantra. But what about the reward part, right? What are we giving up? In other words, if the stock is in an uptrend and it continues to be in an uptrend and it keeps going higher, is there anything that you're giving up, or what is the gotcha in this the bullish potential scenario of the continuation of strength in the stock?
Absolutely. Love the gotcha. And I think there was a phrase that I got from the active trading strategy desk, which is there is a give and take always with options. And it's important to certainly know that. In a scenario where it is going up, I do keep that full premium, which is my maximum profit potential, but it's important to highlight upside risk. So this is truly a neutral to bullish sentiment, as in I call this the danger zone, if you will. If the security was to rally above that premium that I receive, I am not going to participate in any additional capital appreciation. I'm still at my maximum profit potential. However, we're to know your sentiment as in addition to that underlying investment thesis, especially as we're layering on expiration dates, which is the complexity that options offers, just that give and take. So really great question. Thank you, KB.
Of course, my absolute pleasure. A wee bit of management here, right? So we wanted to take a look at something that was put on earlier that needs to be closed out or adjusted. Tony, please speak to us about what we got going on here with this Nike position.
Yeah, KB, just like you had asked me earlier about how do I manage that SPY put trade, let's take a look at managing a Nike trade that I laid out here in mid-April. I laid out a bullish thesis on Nike, at which time I had bought the June 92.5 call options for about $5.50. Since then, the stock has declined about a couple of bucks. So it's moving kind of sideways to lower. What that basically means is that the bullish thesis that I laid out is not playing out, certainly not in the time frame that I was expecting to for this June expiration for the options. So when I purchased that, I purchased it for about $5.50. It's now trading just under $2 for this option, which means that I have lost more than 50% of the premium that I have paid. And the rule of thumb that we have here, once you lose 50%, that's a pretty good indication that your thesis is not playing out the direction you expect it to. And the chances of this trade coming back and turning back into a profitable trade are quite slim. So in this particular case, it's better off for me to close out this trade, save the roughly $2 that I can potentially save on this trade and apply it to the next trade, rather than continue to hold on to it and potentially have time decay erode this down to zero in this particular case with Nike.
Yeah, great points, Tony. Sticking, to the process, that's very important. Staying diligent. Options values do constantly change. So there is the extrinsic value components that we have to be considering. Those extrinsic value components, of course, is how much time is left until this option expires, and market participants' expectations for that stock's movement potentially in the future as well. Those things change, and henceforth, the management of this particular strategy was deemed to be necessary. Jessica, what should our viewers be expecting from you guys next week? What are you looking out for?
Oh, as always, Constantine, we've got a lot of economic events next week covering Fed speak, housing data. We've got some consumer confidence as well. That's not a full list, just some highlights. And I'm personally paying attention to GDP, which is recording on Thursday at 8:30 a.m. prior to our next discussion. And we have PCE, which is the Fed's preferred inflation gauge, at 8:30 a.m. on Friday, post our next discussion. So a lot to digest and consider as we come again together next week.
Certainly. I wanted to thank you for bringing brand new, intriguing trade ideas to all of our viewers in the audience. This brings the first part of this show to a close. I am going to be rolling a few disclosures here on the screen, but wanted to mention, if you want to stay in tune with everything that Fidelity is doing when it pertains to active investors out there, don't forget to sign up to Fidelity's active investor newsletter. You can find it by going to fidelity.com/active investor weekly. Also, my team, the Trading Strategy Desk team, hosts a follow-up show, a coaching session where we digest these trade ideas through the prism of Fidelity tools and resources, where we show you how you can hypothetically recreate these strategies in the simulator and test them or stress test them. If you're interested in those sessions, you can find everything that we do by going to fidelity.com/coaching. You could also sign up for that particular session I've just described by going to the URL fidelity.com/in-the-money follow-up. And that would be at 1:30 Eastern Standard Time tomorrow, Friday. All right, everybody. Well, the second part of the show is going to be us three here in the audience, taking or answering some of the questions that have been asked pretty much directly. So, Tony and Jessica, I hope that you're excited for it. You know, we discussed plenty. Excellent. Tony, how are you feeling about it?
Fantastic. No questions are off limits for me, so bring it on.
Very good. Well, since no questions are off limits, I thought I would start with something that is relatively simple, but I think personal. You know, I've known you for quite some time, the both of you. Known Jessica for a lot longer than I've known you, Tony, but we've worked together plenty. And, you know, I'm curious, between the two of you, you have dozens of years of trading experience, professionally trading for yourself, trading for clients. Kelly was interested in knowing what your best advice would be to a new investor. So if I could take you back to the very beginnings of your own careers, what would you have wanted to know back then that you know now? Kelly's asking.
You want to take that one first, Tony?
Sure, happy to. You know, going back roughly 18 years when I first started learning how to trade options, you know, one of the most important things for me was access to education. And that's one of the fantastic things that you have access to here at Fidelity, is a wealth of education to help you understand the intricacies of trading stocks and options as well. But, you know, beyond that, going a little bit further, I think one of the things that I didn't necessarily know or wish that I had known better back then with regards to trading, you know, was thinking about discipline and how important that is to the success of trading, because a lot of education is catered around technical analysis, fundamental analysis, market analysis, and those things are all very important and important parts of your toolbox. But the really important thing to think about as a trader is a well-rounded trader. And sometimes, you could have the best tools, you could have access to the best indicators, but if you're not applying a form of discipline around how do you manage risk and what amount of risk that you're taking, then that could really lead to disaster sometimes from trading. So I would say for traders, it's really important to focus on risk management and understand with every trade you're making how much you're risking and making sure that you're comfortable with that risk before you place that trade. Don't figure that stuff out after you've placed the trade and the trade is going south or not going in the direction that you expect it to.
Very good. Jessica, your thoughts. There was a lot of wisdom in what Tony shared with us just now. What are you thinking?
Yeah, it's solid as well. I started my career in July of 2009, so very, very interesting time to come into the market. But nonetheless, as far as trading in general, I think it comes down to skill, will, and time would be what is the most important factors. As in, if I have that skill and if I'm lacking it, do I have the will to learn more? And also, do I have the time? Those are the three that is really a stool. And if one is missing, it's certainly going to fall. So I want to make sure you have all of those things, which leads to you having those proper disciplined approach and taking emotion out of trading, but also understanding. And I think that's the beauty really of the financial markets and market participants. It is shifting and it changes. We care about interest rates now, and we didn't as much before. The Taylor rule is coming back into play. Bonds and stocks are shifting positive correlations. There is a lot of changes, which means financial literacy, to Tony's point, is extremely important. But we also have access to all of this information. And what I found within my journey, which I would love to go back to my much younger self and say, is financial literacy is extremely compounding. It builds on itself. One thing, it leads to mastering another. And it's okay that we all learn differently. I'm a highly over analytical person where I don't like making decisions unless I've looked at through every possible angle, but that also gives you an edge. So just knowing how you learn as an individual, bringing it back to the basic skill, will, and time, and then investing that time to understand it. Because in all reality, the complexity of options is you're adding this time decay factor. So time is really important if you think about it in the grand scheme of things.
Absolutely. So there are additional components to consider rather just up or down what you have for your directional bias. So more complexity there, but don't be overwhelmed when you're first starting out. If you have the time, that's all we ask of you, right? Participate in these strategy desk coaching sessions and all of the free education that OptionsPlay provides as well. Well, while we're on this topic, I guess Nick is asking, which I thought was a very pointed question. He says, well, I feel like options are considered to be the boogeyman. Can you talk to the risk reward potential trading options for a younger investor? And I don't think we should be excluding, middle-aged or older investors from that equation. Could options give us options?
Options give you options. That's exactly what it does. And this is really, I think, what's important about what we were talking about earlier, which is how important education is, because there are so many different option strategies that you can trade, and each one of them gives you different risk reward profiles. Now, even though there are dozens of strategies that you can trade, you really have to learn the fundamentals, which are 4 core strategies: long calls, long puts, short calls, and short puts. If you can understand those 4 strategies from a fundamental perspective, what the risk reward profile looks like for each 4, that gives you the foundational knowledge, as Jess was saying, to trade more complex strategies, because all strategies kind of build off on those 4 strategies. And each one has their own unique characteristics in terms of how much are you risking versus how much you can potentially make. They all have their, I would say, pros and cons. But as you trade more complex strategies, which we didn't get a chance to go into any of them today, we traded a long put and a short put here today, but this gives you a good sense of the risk reward of these 2 strategies. But some of the more complex strategies kind of give you a little bit of the best of both worlds, right? And many times you can trade strategies that have limited risk and limited reward. And what that means is that you know exactly how much you can potentially make and how much you can potentially lose before you get into a trade. And you can calculate the appropriate number of contracts so that even in your worst case scenario, the maximum risk that you're taking stays within a tolerance that you're comfortable with. And that goes back to my first point about managing risk before you get into a trade, meaning calculating the appropriate amount of risk that you're taking. Fidelity has fantastic tools that allow you to do that and understand what your risks are before you get into a trade. And that is really important for you to remain solvent as a trader. And this is really some of the things that we see a lot of traders who don't spend the time to learn about risk management upfront risk potentially losing, a significant chunk of their portfolios because, you learn about intermarket analysis, you learn about fundamentals and technicals, but what you don't learn about is the risk management side of things. And all of that stuff goes out the door if you're not managing your risk properly. So it really all goes back to risk management, and options provide you with the options to trade strategies that you know exactly how much you're potentially risking.
Yeah, Jessica, I always say when I'm speaking with clients directly or I'm presenting in some of these coaching sessions, I always say you want to make sure that you make that trade your own, right? Regardless of where you get the trade idea, whether it's Tony's, Jessica's, your neighbors, your siblings, make sure that you recognize why that trade was put on, what is it trying to accomplish? What is the reward potential? I mean, obviously, we are looking to make money in the market, but in order for us to make money, we have to risk money. So defining those risk and rewards and making sure you're not stalling when the position goes against you or goes adversely to what your expectations were. Jessica, so making that trade your own, any other thoughts in terms of what younger, intermediate, or middle-aged or older investors should be thinking about?
Yeah, it sounds like you have lots of conversations about trades with your neighbors there, Constantine. So that's very interesting. Buy me to your neighborhood, I guess. No, I think it's very important to consider your investment thesis. So we started this, and you'll notice this when in the beginning of the show is we talked about how we're feeling about the overall market. Then we translate to our individual trade ideas. And those trade ideas were derived from Tony's perspective from his macro view. Mine was a portion of my macro view, but then it's almost like a funnel approach where now I have a underlying security that I'm identifying and tying an investment thesis to. When you're trading options, you're adding a layer of complexity. And I really think it's human nature. When there is complexity, oftentimes it is paired with fear because it's not understood. But once you take that moment to understand, that fear goes away. And that complexity just simply is you're now trading a product that's not only derived, hence a derivative, from the underlying security, but other external factors impact it, like time and implied volatility. So we just tack onto our investment thesis those other layers. We have a bullish and bearish view. What is our sentiment from the timing perspective? That helps us choose our expiration date. But we also understand holding options till expiration. It's how we had a look back. We didn't hold that option till expiration. We cut our losses because our view was wrong. That's part of the management that Tony is speaking of. And then from the view, when the implied volatility, if it's increasing, will actually increase and inflate options premiums. Or if we expect it to decrease, then that's going to deflate options premiums. So in addition to our investment thesis, to make it less fearful, that's really battled with understanding. And the understanding is just layering on that complexity to your investment thesis. Where do I feel the stock's going to be by what time frame? Layer on technicals to help me have a price target. And then also, how do I feel about volatility? Is it going to increase? Is it going to decrease? Volatility, uncertainty go hand in hand. Just knowing how those all work certainly helps take the boogeyman out, and constantly learning. And one thing tying it all together is the trading strategy desk was on pilot mode when we worked together, Constantine. And so that's a resource that I would have loved to have with my younger self, that our users and listeners, everyone who's watching today, can learn these concepts with really, really great thoughts and going through. So these are resources to get you to that level that, as technology progresses, so does your education. And that's a beauty of it.
Absolutely. There's no one best way to trade. I found that that was kind of a theme, right? What's the best strategy? What's the best trade for this age person or
Yeah.
Y age person? I just wanted to mention, the fact that tools are progressing. There was a question specifically about any AI, artificial intelligence tools that Fidelity offers to help with options trading. I don't necessarily want to call it AI, but there are some tools that help you screen that obviously have a backed methodology-based approach. One of those tools we're actually going to be discussing on the 29th of May here, options strategies powered by OptionsPlay. So Tony talked about the four legs of what you can do with options. You could be a buyer and a seller of calls, and you can be a buyer and a seller of puts. And they have designed a tool that help you sort of analyze that space and fit securities into that criteria. Thoughts, guys? What goes through your mind when you're considering, hey, today I maybe don't have a whole lot of exposure in my account. I feel like I should put something on. Do you start with the strategy first? Do you start with the security that you have in mind or you have on your watch list or you've been keeping an eye on for a while? Do you start with an index that's, experiencing a substantial amount of liquidity in the options markets? What's your process? There's no best way, but share with us some of your common trades.
I think one of the things that you're going to find out as a trader is that inspiration can come from just about anywhere. Now, while we, meaning Jessica and I, largely have scans, pre-built scans that we have that are based on technical and fundamental factors to help us sort ideas out of the roughly 6,000 securities that you can trade options on, the reality is that things pop up all the time, right? Like you said, you could have a conversation with your neighbor and that inspires you to look at a specific option or a specific stock. So I think what's important is you should have some kind of process by which you scan for opportunities, and Fidelity has some fantastic tools and OptionsPlay. We've built some tools together with Fidelity to help you do that. However, I think that more importantly than that is actually having a framework so that whatever idea comes through your way, you have a way to look at that idea and decide whether it's an idea that fits your risk profile, and specifically if it's an idea that fits the correct timing right now. Because like I said, ideas and inspirations come from anywhere. It doesn't necessarily mean that now is the right time to invest in that specific idea. So having a process like Jessica laid out with her technical 13, 26, and 40-week moving averages to help you scan for the trend of an underlying security. So if an idea comes through, put it up in a chart and see if it matches your criteria for whether it's trending higher or lower. And then having also at the same time, I think, some idea of how to evaluate the valuation of a company from a fundamental perspective. So if you have a bullish idea, do the fundamentals align with that bullish idea? So it's important to have a framework so that no matter what idea comes your way, you have a way to screen that idea and decide whether it fits your risk profile and from a timing perspective.
Jessica, I think this one is going to go out to you, kind of directly related to the strategy that you've presented.
Sure.
Today, any particular criteria that you look for when you are selling cash secured puts, besides whether or not you're feeling comfortable being assigned and owning a stock in case the stock finishes below the strike price that you're selling? What else are you looking at in that process of yours?
Absolutely. I tend to deploy that strategy quite often and utilize a wheel strategy. That's the way that I add to my longer term portfolio, and almost the lazy way of an options trader's compound interest portfolio, if you will, is the way that I'm personally going to describe that. Nonetheless, there are certain criteria that makes it more attractive. For example, if we're talking about the time and the implied volatility factor, whenever we are looking at, are we going to take a largely speculative view, as in, am I looking for a sharp directional move, or am I neutral to bullish with the cash secured put? So basically, I'm weighing, am I going to buy a call or am I going to sell a cash secured put? there are risks and rewards to either that we can certainly discuss if you would like. But what I'm looking for when determining the two, if it's not just to add it to my longer term portfolios, what does implied volatility look like? Is that heightened? If it's heightened, then it would make more sense to sell the cash secured put, in my view, because it's going to inflate the premiums, and I would rather sell when it's high and when it's deflating. If it's lowered, then I perhaps would be a little more speculative, as long as my investment thesis and my view aligns with that as well. So we're always marrying the investment thesis, and we're going to come back to that theme, or at least I am constantly, of how do I feel about the security, and then layering on time and implied volatility attached to it. So that is what I would look for. And then we didn't talk about the theta part or the time decay. Theta is just a Greek that we use for the daily time decay or extrinsic value decay of options. And that's not linear. So when I choose my strike price, if it's the intent is to purchase the security, I'll be what you like to call aggressive, Constantine, the sell that at the money put, which increases my probability or likelihood of assignment. That's also a 0.5 delta. We're just using terminology here. But nonetheless, if perhaps I don't want to be assigned, then I might choose a less aggressive strike, something that's further away from the current strike price, which is going to lessen my likelihood of being assigned. So it depends on my intent. Am I selling this cash secured put with the intent to own the security? If so, then that's going to affect my strike price selection. And then in addition to that, I want to look at the options itself. Are they inflated in price? Are they deflated? And then apply my investment process from there.
Yeah, very good, Jessica. I'm just highlighting here for everybody that I'm hosting the Volatility Primer every single Wednesday. I mean, we speak about volatility markets, how to interpret the cost of options through the prism of Fidelity tools and resources. If you want to learn more about that topic and dive in, please make sure to sign up. I mean, one of the other caveats is, look, if you've done your homework, on the volatility spectrum, and you've decided that you want to be, more bullish neutral or less bullish neutral, less aggressive, I think one of the key points, at that point is, well, could I maybe look at some technical levels, evaluate the premium that I'm receiving relative to the strike to see if there's, any support underneath, right, around my break-even point. So evaluating it through the prism of technical analysis as well. And we talk to all of these topics on a daily basis. So please join us and sign up. So we've talked about managing risk, from the perspective of, hey, if the trade is not going my way, what do I do? Where do I cut bait, and how do I recover? But what about, an option strategy that is going really well? So there was, Mr. Singh is asking, after purchasing a long call option, when does it make sense to sell it instead of just sitting there and waiting for the expiration date to get there? So in other words, if you bought a call and the security is going up and maybe the move is really momentous and it's happening a lot sooner and quicker than you were anticipating, how do you structure your profit targets on a long call, or for that matter, speculative long put positions if you're betting on the downside in the stock?
I'm happy to take this, KV, because this is something I've talked about twice earlier in this show, which is the fact that whenever you're buying a call or a put, and this actually applies to also other types of debit strategies like a debit spread, or even sometimes a debit butterfly, is that once you lose 50% of the premium that you've paid on a long call or a debit spread, chances are the thesis that you have on the trade is not playing out the way that you expect it to, certainly not in the time frame that you're expecting it to. So in that particular case, I like to, as a rule of thumb, cut my losers at about 50% loss, because the chances of that trade coming back to profitability at that point are quite slim. And I think it's better at that in that moment to save the other 50% of the premium that is still left on that call or a put option and apply it to the next trade, or maybe roll it to a longer dated option. This way, giving yourself a little bit more time if you still believe in the overall thesis, as opposed to holding that trade, hoping that it's going to come back when the likelihood is that you might lose the other 50% of that long call or put.
What about Jessica? What about the opposite side of the equation? What if you're making money way faster and quicker than you were anticipating? How do you set your profit targets in the positive scenario?
Yep, happy to answer that question. So, one, we've got some very clear rules for that. If I make 75% of my premium on the speculative, I'm going to go ahead and close that out. And that's just a disciplined approach. But there also is further assessment. When we're buying options, we're also buying time, which is something that's going to move against us. And that's why I don't want to hold it until expiration, because if it's hit my price target, I have a risk of that theta decay really kicking in, and then I'm going to sell to close it at potentially a lower price. Depending on where it moves, there's a lot that happens with extrinsic value if it moves too far too fast. So nonetheless, if that occurs, we take the win and we move on, because we add that complexity of, again, the extrinsic value component. And so part of managing those trades is being disciplined on the loss side and the risk assessment, as Tony laid out very clearly, but that also holds true on the gain side. And that's something that we have to care for. Otherwise, we run the risk of it moving adversely if we don't lock in and realize those gain potentials.
Yeah, very good point, Jessica. I think in my personal experience, the worst thing that could happen is seeing a profitable trade turn into a big loser on you, right? It feels way worse when you saw the gain.
It does.
And that turned into a loss. That's right. So staying disciplined and making sure that you have mental, at the very least, profit targets. If you're trading more than a one lot, more than one option contract, maybe scaling out of the position,
absolutely,
in partial terms as well, that could make sense for sure. Folks, as we are wrapping up here, we just have a couple of minutes left. Tony, you did speak obviously to a hedging strategy that you could use, again, to protect your portfolio against market volatility. So that was a great example of what you can do naturally. That's not going to be the only way that you could structure, right, a hedge. There could be a more nuanced multi-leg strategies that you could potentially deploy, but they require fine-tuning, right? So reaching out to Fidelity, attending one of these events and explaining your scenario or situation in grander detail will allow us to help you out more efficiently and directly. Last question for you both before we wrap up here. If markets, for some reason, let's say that we're going to be going into the summer months, right? Back end of May, beginning of June, and all of a sudden the market goes to sleep. So we are going back to the Monday, Tuesday, Wednesday type price action, where it's watching the market as if, it was just watching paint dry, right? Moving up and down within a few points. Are there any particular strategies that you would be thinking about that could benefit from a market moving sideways?
Yeah, and that's really one of the key differences about trading options versus stocks, is that even when markets move sideways, there are opportunities to potentially profit from that. And those are the strategies like Jess laid out, which are option selling strategies. Whenever you're selling options, basically as time goes by, if the stock doesn't move or the market doesn't move, you have the opportunity to collect that time decay or the theta decay that Jess was referring to, then that is potential profit for you. So selling cash secured puts, selling credit spreads, selling cover calls. These are all strategies. Anytime you're selling options, you can potentially profit from a sideways market.
Very good. Well, this was a lot of fun. I want to thank you both. We are a couple of minutes over time here. Very much appreciate you sticking around and answering these questions. I'm sure our audience members are also appreciative of that. If anyone in the audience is wondering, how can they follow you, find what you do? Please share us where you normally reside.
You can find us at optionsplay.com or OptionsPlay on X. But also we have a partnership here with Fidelity where you can actually access OptionsPlay strategies directly on your on your Fidelity platform.
Excellent. Thank you so much. We will see you all again soon, I'm sure. Don't be a stranger. Pop into one of these sessions. Everything that we do resides under fidelity.com/coaching. We'll see you next time. Take care until then.
Thank you.